Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel. We looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. Standard deviation, and maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign, then average, then you double click on average that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom. So I'll click on 65. Then now we separate them with commas. So 65, then comma, 84, then comma, 70, then comma, 76. And if that is the end, you close the bracket, shift and the sign of closing the bracket on the keyboard. After that, you enter, and it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product, in our previous class, I believe we might have included wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo, and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10, you can see it's highlighted, comma, C10, comma, but that's a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here. if you so wish, average and equal sign, or let us use now the other aspects. You can go to the formula place, AutoSum. If you see average, you click on average. There is average here, but this one will pick everything. You can see up to the next place where there is nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to 20, and it will give you everything that you want. If you enter, of course the average is 66.60. You can undo, and again in the formulas you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is just 15 subtraction, then B19 is just this one. So it's wrong. It means you can deduct, or you can do away with it and select whatever you want to get the average of. So you just select, you can see it is moving all the way to 20, and your average is set. So the average is set. Once you have done the correct thing, you click on OK, and you can see the answer is still 66.6. So whichever approach you use, of course the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA, so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values, and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case you can see it's 70 is the highest value here. In this case the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use min. So we are going to use min to be able to get the lowest value. And again, you highlight all the way to this one, and the lowest value there is that one. So the lowest value is 50. The formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so it will just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It is 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest if you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So you double click on the median and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mode. Mode simply refers to the most occurring. So most occurring, that is mode. Most occurring. So let us see, how do you get the most occurring in mode? So you can see mode, the functions available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, the answer is not available. That means there is no most occurring. So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. So there is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mode, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere. These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which will use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Hello and welcome to the lesson. The subject is business and data analytics. Today we are going to study the various types of data analytics. By the end of this lesson, you should be able to explain at least 3 types of data analytics. Types of data analytics. Types of data analytics. Data analytics, learners, is a broad field, and there are 4 main types of data analytics. There are 4 main types of data analytics. Number 1 is known as descriptive analytics. Number 2, diagnostic analytics. 3, predictive analytics. 4, prescriptive analytics. 4 types. descriptive analytics, diagnostic analytics, predictive analytics, and prescriptive analytics. Now, each type here has a different goal and a different place in the data analytics process. Descriptive analytics is the first one. Descriptive analytics helps answer questions about what happened. Answer questions about what happened. What happened. And the techniques here summarize large data sets to describe outcomes to the stakeholders. And by developing the key performance indicators, all right, the strategies can help track successes or failures. And we may also have specialized metrics that are help to track the successes or the failures in an industry. We could have metrics such as return on investment, which is used in many industries, and so on. So the process here requires the collection of relevant data. Here it requires the collection of the relevant data, the processing of the data, data analysis, as well as data visualization. And the process here provides essential insight into the past performance, because data analytics answers the question, what happened? It looks into the past, the history, what happened in the past, what is the past performance, and so on. So descriptive analytics looks into the history, into the past, what happened. The second type of data analytics is diagnostic analytics. And here, diagnostic analytics helps answer the questions about why things happened. Why things happened. This is what happened. Diagnostic answers the question, why things happened. And the techniques here supplement more basic descriptive analytics. They take the findings from the descriptive analysis and digs deeper into the cause of what happened. And the performance indicators are further investigated to discover why they got better, why things got better, why things got worse, and so on. And there are various steps in the diagnostic analytics. The first step being the identification of anomalies in the data. And the anomalies may be the unexpected changes in a metric or a particular market. The second step in the diagnostic analytics is the collection of relevant data. Collection of relevant or related data. This is data that is related to the anomalies. Okay? So first of all, I've said the first step in the diagnostic analytics is to identify anomalies in the data. Then number 2, data that is related to the anomalies is collected. Identify anomalies in the data, then collect data related to the anomalies in the data. Then after that, statistical techniques are used to find relationships, to find trends that explain the anomalies. That is diagnostic analytics. I repeat, identify anomalies, step number 1. Step number 2, collect data related to the anomalies. Then number 3, use statistical techniques to find relationships, to find trends that explain the anomalies or the cause of the anomalies. Let me put that down. 1, identify anomalies in the data. 2, collect data related to anomalies. 3, use techniques to do what? To identify the, or to find relationships, to find trends that explain the anomalies. Use mathematical or statistical techniques to find relationships and trends in the anomalies. The third type of data analytics is predictive analytics. Predictive analytics, on the other hand, helps answer the question, what will happen in the future? Predictive analytics helps answer the question, what will happen in the future? And the techniques, the techniques here use historical data to identify trends, then determine if they are likely to recur. The predictive analytical tools provide valuable insight into what may happen in the future, and its techniques include a variety of statistical as well as the machine learning techniques, such as the neural networks, the decision trees, the regression, and so on. So based on historical data, the predictive analytical tools can help the firm answer the question, what will happen in the future, by looking at trends in the historical data, the past performance. Predictive analytics, from the word predict. These tools may help a company to answer the question, what will happen in the future? Tools such as regression, machine learning, and so on. Do you understand? Yeah, that is pretty clear. Predictive analytics. Then the last type of data analytics is prescriptive analytics. Prescriptive analytics helps answer the questions about what should be done. What should be done? What should be done? Prescriptive analysis helps answer the questions about what should be done. What should be done. And by using insights from the predictive analytics, data-driven decisions can be made. Data-driven decisions can be made based on predictive analytics. Data-driven decisions can be made, and that allows businesses to make informed decisions in face of uncertainty. And candidates, prescriptive analytics techniques rely on machine learning strategies that can find patterns in large data sets. Patterns in large data sets. And by analyzing past decisions, by analyzing past events, the likelihood of different outcomes can be estimated. All right? Prescriptive analytics help answer the question, what should be done? This type of data analytics provide insights about insights that businesses need to make effective and efficient decisions. They provide insight that businesses need to make effective and efficient decisions. So these are 4 types of data analytics. We've said data analytics is a broad field. We've briefly described 4 types of data analytics. The first one being descriptive analytics, which you've said answers the question, what happened? Diagnostic analytics answers the question, why things happened. Number 3, predictive analytics answers the question, what will happen in the future. And lastly, prescriptive analytics helps answer the question, what should be done about what should be done by using insights from predictive analytics. You've said also that data-driven decisions can be made. Data-driven decisions, because the decisions are based on past data, on past big data. So these are 4 types of data analytics: descriptive analytics, diagnostic analytics, predictive analytics, prescriptive analytics. Here is your today's assignment. Explain 4 types of data analytics, and when doing the assignment, make sure your notes, you don't make reference to notes, you don't make reference to videos. Try and see if you can recall what you have learned from your memory. Thank you. Bye-bye.
Hello student, my name is Isaac Juguna, and welcome to Manifest Publishers, and also welcome to this class today. And we are learning, today we are going to cover core application of data analytics. The subject we are going to cover today is a core application of data analytics, under the subject known as application in financial management, application in financial management. And the unit or other subtopic that you're going to cover is loan amortization. You're going to cover a subtopic called loan amortization. And in that case, what is the aim? By the end of this lesson, you as student, you're going to be able to prepare a loan amortization schedule. You're able to prepare loan amortization schedule, and we do it using Microsoft Excel. We're going to do it using Microsoft Excel. And to start with, first you can see we are on our computer, we are on desktop. We are going to know how to create a folder where we are going to then open the Excel, then save. Creating a folder, we just right click, new folder. Let's say our folder, we call it data analytics. Then enter. Then after that, now we open Excel. Just start button, just click start button, then you open Excel, Microsoft Excel, or other still you can just come and write there Excel. Once you open Excel, it is very important you click blank workbook. So we start by saving it. We save it in our folder. So file, save as. It is we created our folder on the desktop. So we click here desktop. We choose our folder. Our last state we can create it here. Call it it is data analytics. Let's write it in capital, data analytics. Then enter, just double click. Then let's we give a file name. In this case, let's call it loan amortization. We call it loan amortization. Then press enter to save it. So now we have opened our Excel, and we have saved. So now in this case, in a very simple terms, let me here as I am in Excel so that you are able to see it very well. Let's increase the font a little bit. So let's ask ourselves, what is loan amortization? What is loan amortization? What is loan amortization? So in this case, we can define it in just simple words. Basically, we say loan amortization, it is the process. It is the process of reducing. It is the process of reducing or paying off debt with regular payments. So we are saying that loan amortization, in this case, let me increase the size. So we are saying it is the process of reducing or paying off debt with regular payment. That is loan amortization. And in this case, to assist us to know how to do the loan amortization, we are going to have to do a simple question that is going to help so that we understand how to prepare the loan amortization schedule. Once again, let me increase the size a little bit. So let me, the question is that an investor borrowed a 6-year loan amounting 1.8 million at annual rate of 12% at annual rate of 12%. So we are required, let me increase the size still again a little bit. So required, or rather the question now you have been asked, required, we prepare, the required now, the question is prepare a loan amortization schedule. Prepare a loan amortization. Prepare a loan amortization schedule. Prepare a loan amortization schedule. So let me repeat the question. So you're saying an investor borrowed a 6-year loan amounting to 1.8 million, and annual rate, at annual rate, borrowed, and that is at annual rate, that is at annual rate of 12%. So you are required to prepare a loan amortization schedule. So that is our question. So now, using this Excel, how do we go about preparing this loan amortization schedule? So let me highlight where I want to work and increase just size a little bit so that it is very visible. So now, from our question, we have various things. We have the rate. We are given the rate, which is 12%. We are given the amount, and we are given the period, which is now 6 year. It is 6 years. So what we do, we just prepare a small table here. We come and write interest. Write interest that way. Then the other one we write, we have the number of years. We are given the number of years, which is 6 year. So we can write number of years, number of years. And then the other thing we are given is the amount borrowed. We are given the amount borrowed. We are given the amount borrowed. So you just write it there. So that's what you have as per question. That's what we have. So now, for us to be able to prepare a loan amortization, so we are going to use a formula which we call present value annuity factor. That is, we are going to use present value annuity factor. So here we write that way. Can write in capital present value annuity, present value interest annuity factor. Then after that, we need to know the installment. What shall we be paying on a regular basis? So you write installment there. Just write in small letters. We write installment like that. Then after that, so in this case we have the interest, and interest from our question is 12%. So we write 12% there. Number of years, it is 6 year loan. So we write 6. Amount borrowed, the amount borrowed in this case is 1.8, or rather 1,800,000. Write our figure there, 1,800,000. Then from there, that's what you have. So here we can form a table. Here we call it year. Then after that, the years we have it is 1, 2, 3, 4, 5, 6. Then after that, we have the balance. We have the balance brought down. Then from there we have another column here, we call it interest. After that you're going to have the installments, and then let's just make it, or rather resize it a little bit. Then after that we have now the balance. Here we write balance carried down. So that is our table. So in this case, so that it is can be able to see it very well, let's just highlight. We put the borders. So borders is just home. Here we have where icon called borders. You click there, choose all borders. Just choose all borders. So meaning that now you can be able to view it very well, or rather let me make it much better. So let me click up there, alignment, then border. I choose a thick color a little bit, then I click outline and inside, so that now you can see this is the price of our interest, or rather we have now the table where we are going to work to do our calculations. So now in this case, very important, we have the interest, we have the number of years, and we have the amount borrowed. So how are we going to know the installment that you're going to pay every year? And in that case, or rather, what shall we be paying on a regular basis every year? So in this case, we say that we are going to use the present value interest annuity factor, and we have a formula for that. So we can just write that formula just here. Let's just write, this is, let me write in capital, present value interest annuity factor. So the formula I'm going to use is this. We say that it is equals into bracket 1 minus into bracket 1 plus R, which is the rate, as R, which is the rate, then all that cross the bracket, least power n, least power negative n, all that cross the bracket, all that divided by R. So that is the formula we are going to use. So the formula for present value interest annuity factor is equals, that is 1 minus into bracket 1 plus R least power n, all that divided by R. So you're going to apply it here on our table, that is a present value interest annuity factor. So we write equals, you open the bracket, that is 1 minus into bracket, that is 1 plus R. What is our R? Is 12%. So you just click that 12%. Then you close the bracket, raised power negative n. N is number of period. So we click n, which is our number of period. Then after that, you close the bracket. All that, what you have written, we divide by, so you write divide by R. So you click 12% again. Then after that, you just enter. Then after that, you just enter. So if you click, this is now, we have seen our result is 4.111407324. So if you click here, you check there at the formula bar, you can see we have written it is equals 1, that is equals into bracket 1 minus into bracket 1 plus R, which is 12%. In that case, it is dedicating I10 according to which column is and which row is. It is I10. You close the bracket, least power negative n, which is indicating that it is I11, this one 6, I11, all that divided by the rate once again. So having done that, how now do you calculate the installment? To calculate the installment, you say that it is equals the amount borrowed, which is 1,800,000, divided by present value interest annuity factor, then you enter. So now you can see the installment that you'll be paying on regular basis is 437,806.2932. That is the installment that you'll be paying on regular basis, or rather in the, our question, on yearly basis. On yearly basis, I repeat, that to find the installment, you just write equals the amount borrowed divided by the present value interest annuity factor. So enter. Then after that, now we have our table here. The balance brought down. The balance brought down in this case, it is equals the amount we borrowed, which is 1.8 million. Then what will be the interest? The interest of that amount, it will be equals, we have our rate is 12% times the amount borrowed, then enter. So I repeat, I've said that it is equals the interest rate multiplied by the amount borrowed, which is 1.8, enter. So having done that, it is good that you click that figure. You can see where we have the I10, which stands for the interest. Since this interest rate of 12% is constant, so we lock it. We lock so that it can be constant. So to lock it is a shift and 4. In between the label I, shift and 4. That is $sign. You put $sign to lock it. Then after that, how do you find the installment? The installment is equals. It's just here, installment. Let me repeat. You click the installment, the cell for installment, you write equals, click the figure here, which is 437,806, enter. So this installment, still it is constant. Every year you are required to pay 437,806. So still it's good that you lock it. Shift R in between the label. Enter. Then after that, what will be now the balance carried down? The balance carried down, we say that it is equals what you borrowed, 1.8, plus the interest minus what have been paid the first year, which is 437,806, enter. So the balance carried by the end of the year, the balance carried down, it will be 1,578,193.707. So what will be the balance brought down for the second year? It will be equals, you click the balance carried down for the first year, enter. So what will now be the interest for that amount for the second year? So it is equals the interest times our figure now balance brought down for the second year, enter. So we say that we lock the interest part, so we click here, $sign, and this other one, $sign, enter. Then what about the installment? So the installment remain the same, which is this one, 437,806. So we click it. So still, it's very important that also we lock it. Also we lock it. and again here we lock it, enter. Then what will be the balance carried down for the second year? Once again it is equals the balance brought down for the second year plus the interest of the second year minus the installment. So up to that point you can see the balance brought down is reducing, and you can see also the interest amount. This is now the interest amount is also reducing. But what remains constant is the installment, what you are paying on yearly basis. Those regular payment, just from our definition, are hello student.
Greetings to you all and welcome to the lesson. The subject is business and...
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri and I'll be taking you through alternative investment analysis. We are looking at commodities, and what we are going to specifically cover under commodities include the following. We are going to look at the differences between the forward contracts and futures contracts. For forward contracts, forward and futures contracts. We will move on and look at initial margin. We are going to also look at maintenance margin. Then we will move ahead and look at rolling contracts and what the terminology refers to in terms of rolling contracts. So rolling contracts. We are going to look at rollover decisions. There are two key decisions that need to be taken over when trying to roll over either futures or forward contracts. Then we will move ahead and look at term structure of forwards. Term structure of forward prices. There. And then we will conclude this first lesson by looking at forward pricing. That. Now this is what we're going to cover in today's lesson, and we start off by looking at the differences between forwards and futures contracts. As well, it would be important for us to also try and identify the similarities between futures and forwards. So let me start, if you allow me, let me start by looking at the similarities between forwards and futures contracts. If there are differences, then there must be some form of similarities, obviously. So let's start by similarities. Between contracts and futures contracts. Now, before I begin with the similarities, I need to first of all explain what forward contracts are and what futures contracts are. Suppose that this is a parcel of land. Individual X owns that parcel of land. Here we have another individual, Y, who is what we can be able to say an intermediary or a broker. Individual X, having owned this parcel of land or owning this parcel of land, decides to plant maize like so. And once they plant the maize, say at the end of day 2, they've actually completed planting maize in that parcel of land. What happens is that Y could approach X and tell them that your parcel of land has got maize that I am interested in. The interest that Y may have towards that parcel of land is that they intend to purchase the maize that is produced on that parcel of land upon maturity. So that represents a future kind of decision there. So we are saying that Y could approach X and come up with a contract. Y would come up would from Y's perspective enters into the contract with the intention of buying the maize from X. X, on the other hand, will enter into a contract with the intention of selling the maize to Y. There must be a contract price, contract, futures, price, such that when Y and X enter into an agreement, the price at which X will agreeably sell to Y, and the price that Y will agreeably purchase from X should be harmonized, or there should be some form of harmony. So we are saying the contract futures price would be, supposing this parcel of land produces 10 bags of maize, 10 bags. Now, X and Y enter into a contract, and that X will sell to Y at, say, in future, upon maturity of the maize, 1 bag at maybe say 1,500, sorry, say 1,500, like that, shillings. Supposing the day that X and Y enter into a contract, the forces of demand versus supply state that the forces of demand and supply state that probably it's maybe 1,000 shillings, like that. Upon maturity, say 3 or 4 months down the line, when the maize has reached some form of maturity, or has reached maturity, what happens is that if based on the forces of demand and supply at that time in future, say the demand versus supply is maybe say 1,300. What would happen when X has to sell to Y? At what price will X sell to Y? X will have to sell those 10 bags of maize to Y at the contract price of 1,500, like that, even if it is 1,300. That means X will benefit, will receive some benefit, and Y will lose out. Why? Because the forces of demand and supply at that time in future is saying that 1 bag of maize is going at 1,300, which is slightly lower than the contract price which they had set, say, 4 months before. That is where X will benefit, because instead of selling it at 1,300, they will sell it at 1,500, which provides a premium of about 200 shillings. However, supposing that the force of demand and supply state that the bag of maize, 1 bag of maize in future is 1,700. That means X will have to sell to Y at this contract price, which you are saying is 1,500, as opposed to the 1,700 based on force of demand and supply. That is what you are saying is the simplest form of futures contract. Now, futures and forwards have got almost the same description in terms of the methodology behind each. However, we will first of all look at the similarities between the forward contracts and futures contracts there. So this we can be able to say is an example of either a forward contract or a futures contract, like that. But in terms of the similarities, we can be able to state the following. We can state this. Number 1, futures and forwards can either be deliverable, or cash settled. Contracts. That is how they are similar. I'll probably provide the description of how they are different. Futures and forwards are priced to have zero value at the time the investor enters into the contract that. So they are priced at zero. So from today they are priced at zero, and then it approaches what we are saying the futures price as it moves on like that. Say 30 days. What happens that it's from today it is priced at zero, but as it approaches the 30th day maturity date, then we are saying that they tend to actually move towards the futures or the forward prices like that. That's what we are saying there. Now those are the two major similarities between forwards and futures. Now let's look at the differences between forwards and futures. So differences between forward contracts, forward and futures contracts, forward and futures contracts. Now the best way to describe this is in form of a table. We are saying the table is going to provide a very clear distinction over here. So here we have futures and here we have forwards. That. So what I can be able to do, I can be able to provide that clear distinction right here. Like that. Sorry. Pardon me, I think I didn't write properly, but that's okay, right there. Like that. We can start by saying that futures are traded on an exchange, whereas forward contracts are not traded on an exchange, or we can be able to say they are private contracts there. So number one, we can say futures are exchange traded. One on this side, they are private contracts. They are not traded on an exchange. Number two, we are saying that futures are standardized contracts. They are standardized in the sense that they are sold in, if it's dealing with commodities relating to rice or maybe wheat, they are sold in bushels, in bags of bushels, or maybe a combination of 12 bags like that can form one futures contract like that. So that's what we're saying is or characterizes futures contracts. We can say that here these are standardized contracts. Here these are customized contracts. That. Customized in the sense that if customers want to buy in multiples of say 3 bags, not in multiples. Here we are saying it must be in multiples of say, for example, 12 bags of maize like that. You must either buy them like that. Here we are saying if you do not want to buy in multiples of 12 bags, you can be able to buy in smaller bags. You can buy in multiples of 6 bags. You can be able to buy in multiples of 3 bags, and so on and so forth. So they are customized or are tailor-made towards customers' preferences. There, number two. Number three, we are saying that these futures contracts, being exchange traded, they have a clearing house. They must have a clearing house there. On the other hand, the other side, there is no clearing house that exists. No clearing house exists. Probably I should write this one over here. Clearinghouse exists. Yeah, clearinghouse exists. That. Number 4. These contracts are regulated because they trade on an exchange. They must be regulated. There, so we're saying this regulated. 4 here, not regulated. That. So those are the primary differences between futures and forward contracts there. Having looked at that, we can be able to go back to our we need to follow here. So we've looked at the differences between forwards and futures contracts. Now we need to move ahead and look at the initial margin and maintenance margin there. So right here, we can now say initial margin, like that. The initial margin is the initial amount of funds that must be deposited into a futures account before any trade takes place. Mark my words, I said futures account. Why? Because futures trade on an exchange. So you must perform an initial deposit of funds to the exchange. Say you are intending, this is the buyer right over here, this is the seller. You intend to buy a given number of lots, say for example or bushels of wheat from an individual who you may not know at a pre-specified spot price there or futures price. So what happens is that you must make an initial deposit to the clearinghouse. Even the seller must make an initial deposit to the clearinghouse so that at the end of each day, both of their accounts are mark to market. Mark to market, like that. Marking to market means that you must adjust for either gains or losses each and every day. So for example, if the buyer over here made an initial deposit of 1,000, here 1,000, like that, and then maybe because of the changes or the trading processes, this is the exchange, like that, the buyer ended up losing 100 and this individual ended up gaining 100. So at the end of each day, here the account will be 900, like that, and here it will be 1,100, like that. That is the closing price at the end of the first day. That is what you're saying is marking to market, adjusting for changes in the spot prices per day or the futures prices per day there. So the initial margin is this 1,000 that you must deposit with the exchange or with the clearing house right there. So we write it, put it down in writing and say that the initial margin we're saying is the collateral that must be deposited in a futures account before any trade takes place. Any trade takes place. Like that. That is the initial margin, the initial amount of money. Now we can look at maintenance margin on this other side. Maintenance margin. Now we are saying the maintenance margin is the amount of funds that must be maintained in the futures account that you've actually deposited with the exchange, like that. It must be maintained. So there's a minimum balance that must be maintained in the futures account so that a trade can continuously be taken, either bought or sold. So we can say is the amount of margin. Let's say the amount of margin expressed as a currency per contract that must be maintained in a futures account for an open position. So it must be maintained at any given point in time. So when trades are actually taking place, the maintenance margin has actually been met and probably may be even executed at any given point in time. That is what we're saying is the maintenance margin. Now we need now to move on and look at the rolling contracts. Rolling contracts. Now, because we are saying that futures contracts usually tend to expire either within 30 days or 60 days or maybe even 90 days like that, supposing an investor wants to continuously seek exposure towards futures, what does he or she need to do? It means that at the end of the first contract, maybe 30 days from now, they need now to reestablish a new position from over here that will continuously provide that exposure, that desired exposure that they intend to maintain. And then they continuously need to maintain that exposure and continuously, and so on and so forth like that. Now, the process of maintaining that exposure towards futures contract is what we are saying rolling contracts. You are trying to roll over. Supposing you've earned a return within that period, and you intend to earn another return, or you expect to, based on your analysis, you expect to see that there's going to be additional returns going to be earned over the next available period, then you tend to roll over or carry forward. You intend to avail those funds to avail that exposure continuously towards futures by carrying it forward to the next available futures contract right over there. That is what you're saying is rolling contracts there. So we can say refers to the process of continuously seeking exposure to a futures position even though futures contracts are short term. Investors may seek exposure continuously by carrying forward investments in futures contracts. Carrying forward. What do you mean? Rolling over like that. Now let's look at rolling over decisions. What are the key decisions that need to be considered when you want to carry forward or roll over your position? I'm trying to seek exposure, continuous exposure towards futures. So we're saying over decisions. The rollover decisions, like I had mentioned at the beginning over there, I said there are two key rollover decisions. See? decisions that must be considered. That when the rollover will be considered, we're saying number one, when the rollover will be initiated, that is very key. And number two, we're saying which deferred contract will be used in the roll. That which contract are you going to consider? Are you going to consider the 6-month contract? Are you going to consider the 9-month contract, like that? That is, these are the two key decisions that you need to consider when rolling over. Now, having looked at the two decisions, we now need to move forward and try and assess the term structure of interest rates, or rather the term structure of forward prices there. Term structure of forward prices. Now, the term structure of forward prices represents a relationship between the forward prices and time. So, if we have this kind of arrangement over here, you tend to find this is maturity and this is price, like that. Write it properly here, maturity. This is the futures price. In trying to determine the term structure of forward prices, say for example of corn, it could be like this, just a hypothetical example. We are saying that in trying to determine the term structure, we need to consider the expected futures price as well as the spot price, like that. So we are saying this. We're saying that in determining the term structure, of forward prices, the expected futures price at time t and the spot price need to be assessed. So we are saying that we could be able to try and identify at any given point in time, like that. This is the maturity at any given point in time. What is the expected price, like that? Right part over there, like that, we can be able to provide the price given to us like that. So we are saying that this general structure, say for example for corn, can be used as, say, a benchmark, so that you can be able to determine the expected futures price with a given spot price there, like that. So in trying to plot the price of corn against the respective maturity, we can be able to get the term structure of forward prices, like that. Now, once we've looked at the term structure of forward prices, we can link it now with the forward pricing. The forward pricing or the process of determining the expected forward price, we can be able to come and deduce the following formula. FT, like that, is given as S for all maturities, like that. where I can say FT, like that, is the forward price, or the current forward price. Like that. Then we can say S is the spot price. Like that. But for this formula to hold, there are assumptions that we need to consider over there. So the assumptions that hold for this kind of scenario. So the assumptions that make this model to work are as follows. I can put a semicolon there on this other side. One, transaction costs and taxes don't exist. That means if it was not going to hold, we would need to put a plus the transaction cost plus maybe a component of taxes over here. So futures price at time t, or the current forward price at time t should be equal to the spot price for all maturities, so that it can be in line with the term structure of forward prices. Number two, the risk-free rate is 0. We don't have a component of the risk-free rate. So the component of riskless asset does not exist. Number three, we are saying the underlying asset can be borrowed at 0 cost. 4, we can say the following, that the underlying asset has no dividend yield, convenience yield, or storage costs. So these are the underlying assumptions that hold for this forward pricing there. Now that brings us to the end of this first lesson under commodities. We hope that you have enjoyed the lesson and that you will continue being with us throughout this topic. Thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello Lana, welcome to Manifested e-Learning Forum. My name is Emlyn Ngwiri and I'll be taking you through alternative investment analysis. We are looking at commodities, and in today's lesson we are going to look at the following. Building on what we did in lesson 1, we are going to now look at contango and backwardation. You'll recall that we looked at, in lesson 1, we had looked at the term structure of forward prices there, and we even ended up drawing a graph there to try and explain the term structure of forward prices. And we are going to build on that model right over here. So we will be looking at a normal contango and a normal backwardation right there, right under that. We will move ahead and look at cost of carry model, where we'll be able to come up with a relationship that includes the component of storage costs right there. Then we will move ahead and look at forward prices and arbitrage. That. We'll move ahead and look at arbitrage-free pricing and financial forwards. Move ahead and look at arbitrage free pricing of we're saying arbitrage free pricing of physical asset forwards. Physical asset forwards. And that is what is going to conclude our lesson for today. So we start off by looking at contango and backwardation. So we are looking at contango and backwardation here. And backwardation. There. So we can explain in brief what contango and backwardation is, and then we will build on that by looking at what a normal contango is and what a normal backwardation is. A contango, we can start by saying contango, can say a contango refers, I can underline that, to a situation where the current forward price is greater than the current spot price. Yeah. Obviously, a backwardation would represent the reverse or the contrary opinion on this. So we are saying over here, in brackets, you can put where the spot price, the current forward price, so F is greater than S, like that. A backwardation line that refers to a situation where the current forward price is less than the current spot price. Spot price there. So we are saying what happens is F is less than S, like that. Now we had looked at the term structure of forward prices, and I can come on this other side. Just in brief to explain what we had looked at. We had looked at the price over here, and we had looked at maturity right under that. And we had drawn the prices trending to move like that, in that scenario there. So we are saying that a contango refers to a situation where the forward prices, the current forward price, or what we're saying, the forward price looking ahead is greater than the spot price there. That is where analysts or investors try to earn a return. If there's a difference between the forward price and the spot prices there, that's where now we are seeing analysts usually try to leverage or hedge fund managers try to leverage on the differential between the forward prices and the spot prices there. Likewise, a backwardation is where the forward prices is less than the spot price. That can also be a scenario where you can try and earn a return that is very significant, and that can be able to lead to overall increase in value or increased returns to be realized by the investor. there, or the analyst, like that. So now we move on and try and explain what a normal contango is and what a normal backwardation is. We can do that over here. We can say that a normal, and we can start with contango, refers to a situation where the current forward price, is greater than the future expected spot price. The key word there is expected. Unlike what we had said over here, we're saying a contango is where the current forward prices is greater than the spot prices. Now here, the current forward price is greater than the expected. What you expect the spot price to be, that is what we're saying a normal contango refers to there. A normal backwardation refers to a situation where the current forward price is less than the future expected spot price. Spot price there. And this is very important because we're saying, like I had said before, analysts usually try to find differentials between the spot price and the expected or the futures, the forward prices there. Now that differential over there is represented by the term structure of interest rate. So we quote the yields against the maturities there, so that you can be able to see how much yield for a given maturity, what are the yields on commodities yielding. Remember, there is financial forwards and there is what we're calling commodity forwards. Those are two different instruments. Financial forwards relate to or analysts who invest in financial forwards try to get some form of exposure when they invest in financial assets, including stocks, bonds, and the like that. But analysts who try, or investors who try to get exposure through physical commodities, you're saying those are the ones now who try identify the difference in terms of the prices of forward prices and the spot prices, and you try and get some yield from that there. So that is it about normal contango and normal backwardation there. We move on and look at the cost of carry model there. But before we go to the cost of carry model, I can probably try and emphasize a small maybe graph right over here, where we will be able to try and explain a contango situation, where we are saying if you have maybe a given level price over there like that, this is what we're saying is a spot price there. Probably today's price. That's what we're saying. Now, if you're trying to say contango, of course you expect the forward price to be represented by price, like that. Forward price is greater than the spot price. That is what we've demonstrated right over here. And this is very significant. Graphs also need to be complete, because we are saying that here we need to plot the yields over here against maturity, like that, and then over here we have the prices. That I'm just trying to relate it with what you've written over here, like that. What you've written over here, forward price is greater than the spot price. Right over here, you can see this is what you're saying. This is the spot price being greater, like that. Of course, the opposite will hold for backwardation. So here I can be able to say this is contango. That now on this other side, I can be able to draw a graph that shows us how the backwardation scenario looks like. So here we have maturity, and here we have the price here. So here we have the spot prices existing like that, and now scenario like that, spot price, and this is the forward price like that. So this we're saying is backwardation. That. Now, having looked at this, it would be good for us now to move on and look at the cost of carry model. We're still building on what we've actually learned, the term structure of forward prices and the concept of contango and backwardation, which analysts try to seek, whether they're investing in financial forwards or commodity forwards or physical commodities themselves. That's what we're saying. We'll be building on that. And having looked at that, let's look at the cost of carry model. Yeah. Now we need to mention something over here. We can say this is a measure of the financial difference between holding a position holding a position difference between holding a position, I can say, in the spot market, in the spot market, like that, and holding, move on this other side here, and holding a position in the forward market involves in the forward market, you can say it involves two strategies with identical economic results. That, but different prices, that reflect the cost of carry, cost of carrying, economic strategy. Like that. So the relationship, you can say the cost of carry relationship is as follows, where we can have, if you recall in our previous lesson, we had said that the forward FT, the forward price, is equals to S for all maturities. Like that. That is when we are looking at the term structure of forward prices, like that. Now we are building on this in our previous lesson. We'll be building on this by looking at now a different model, which is of the form FT, like that, is given as the spot prices plus the carrying costs. This is more so for commodity forwards, not financial forwards, for commodity forwards, because we are saying the cost of carrying the asset is what is going to be considered right over here. Now, having looked at the cost of carry model, now we will build on this so that we can look at different scenarios where we can be able to try as much as possible to look at the forward prices and arbitrage. Arbitrage represents a scenario where a security or an asset has been issued in two different, the same asset has been issued in two different countries, for example. Maybe in one country it is much cheaper than the other country. It means that the difference in pricing, individuals can be able to leverage or earn riskless arbitrage profit by investing in the one that is cheaper and then selling it at a higher price like that. So probably I'll be able to demonstrate that shortly. So let's look at the forward prices and arbitrage like what you have said over here. This is what you're going to look at now. Forward prices and arbitrage. Now, if this is, just for example, this is Kenya, this is Uganda. Suppose a bond, just let me use the example of a bond. Yes, I know we are dealing with commodities, but for purposes of simplicity, let me use a bond. Suppose a bond has been floated here in Kenya and it is priced at, say, 1,000. That. The same bond, if you convert Kenya shillings, this is shillings. Suppose the same bond has been floated in Uganda at the same price, but now converted into Kenya shillings, it's probably maybe at 950. If you convert it into Kenya shillings, it's the equivalent of that. It is the same bond, but has been floated in different countries at the same time. What happens is that the analysts or the investors in Kenya, if they realize that there's an opportunity that exists in the financial market or with the bond, what they can do is that they can be able to invest in the bond, the cheaper security. Yes, it is the same security, but the cheaper security, which costs 950. So that now they can now sell it at now 1,000 when the prices are actually increased. Remember, if there are too few goods that exist like that, as compared to the population over here where there are so many individuals who want to demand, say for example, the very few, the little tomatoes that have actually been grown in an economy, what happens is that since there is so much demand for these products over here like that, what happens is that if it was initially one tomato was going for 20 shillings, now because of that demand, it will increase the prices to probably maybe 40 shillings like that. That is the same principle over here. Capital flows will go into Uganda to purchase or to procure to purchase that bond, and that will cause the prices to start moving up like that. Once it moves up like that, it will be able to settle off at the initial 1,000 shillings price over there, because we are saying we expect an equilibrium price to actually exist there. So that is what we are saying is arbitrage. So those individuals who bought the bond at 950, they will probably now decide to sell it at 1,000 shillings, earning a riskless profit of how much? So it's 1,000 that you're selling it at minus 950. They will make a clean 50 shillings profit like that. This is just a hypothetical example like that, but in the market, this is exactly what happens. Investors tend to earn riskless profit of this form like that. It's the same instrument, but you earn riskless profit by just taking advantage of price differentials if the instrument is floated in different countries like that. So we can say that for an underlying asset, there that does not pay any income that. The forward price, is as follows. That where we have the F. Now we are building on this. Please note, guys, that this is what we're trying to build on. T, like that. But now we include is equals to the spot price. It's almost similar to that, multiplied by the transcendental factor, E, like that, and then power R T. Put T capital. R T. Where we start with FT. We had already explained what FT is. Price, the forward price there. Then we have S, spot price. E, transcendental value. That represents continuous compounding. R, risk-free rate, cost of interest, and T represents the time like that. Now, the best way to demonstrate these forward prices and arbitrage is by looking at an example. So let's look at an example that will incorporate that there. The spot price of gold is currently at 700 shillings per ounce. The current continuously compounded interest rate is 4%. Compute the price of a 6-month forward contract on gold. So we are trying to determine the forward price. And the forward price, it can be gotten using this formula. Here you have the spot price, the transcendental value. There on your calculator you have that E, and then R is the required risk-free rate. And the risk-free rate in this case is continuously compounded. You've been told is 4%. And then you're told that the time factor is 6 months. And you know 6 months out of 12 months is what we're saying we will be able to use. 6 out of 12, because in a year we have got 12 months there. So putting it all together, we have solution. So solution, we say FT is given as, what is the spot rate? The spot rate I can see here given to us is 700. E, which you're saying is a transcendental value, the continuously compounded value. Then R, the rate we're saying is 0.04, and then times 6/12. Why 6/12? Is because we're trying to get the proportion 6 out of 12 months there. So now putting it all together, how much do we get? We first of all work out the transcendental value there. So we're saying shift E1. We want to first of all get what the value, the transcendental value is. This transcendental value I can see is 2.71828. Please check from your calculator there where you'll see an exponential of the transcendental value there. I get 2.71828, and then that you now raise it to power that there. So power, it's 0.04 multiplied by 0.5. This 6/12 is the same as 0.5. Like that, I get 1.020. So it's 700 multiplied by 1.020, like that. So that you multiply by 700, we have 714.14. 714.14, like that. That is the futures price, or the forward price rather. This being the spot price, we expect that the forward price will be 714.14. How many months ahead? 6 months ahead. So 6 months ahead, we expect the price to move from 700 to 714.14, like that. So that is an example of how we can be able to calculate the forward price for an asset that pays no component of income, like that. That is it. Over here, we are done with the forward prices and arbitrage, like that. Now we try and twist it a bit. We try and delve a bit deep, and we will delve a bit deep now, building on all of these concepts over here by looking at arbitrage-free pricing and financial forwards. Then we'll move ahead by looking at arbitrage-free pricing and physical forwards. How do we determine the forward prices when we are dealing with financial forwards? I already said that financial forwards represent assets that are inclined towards or seeking exposure towards indices or fixed income instruments or based on, say, for example, the US treasuries, like that. That is what you're saying is financial forwards, financial assets there. Physical forwards, now you're dealing with, say, barley, wheat, physical commodities themselves. Now, the pricing over here will be very different. So we are going to look at it on this side. So we can say arbitrage, free pricing, and financial forwards. We can say financial or financed positions. You can say financed positions allow investors to acquire economic ownership of an asset without forfeiting the cash value of the position You can continue and say that financial forwards include, so that we're providing a description of what financial forwards are, include futures, contracts on stock indices, and also US Treasury bond futures. US Treasury bond futures. Now, we can be able to now build on what we've actually done over here. Notice what we've done over here. I can rewrite it with your permission. I can write it over here. We said FT is given as S, the transcendental value there like that, RT. That is what we said from there. Now, when we're dealing with financial forwards, the arbitrage-free pricing formula changes. We have FT, calling from this one over here, FT is given as, we have the spot price, we have the transcendental value there, and then we have R minus D, like that. I'll be able to explain what that is, then times T there. Notice what we had. We have the R. We've already explained what R is. R is the risk-free rate. Now, we'll also need to determine what the component of D is, and we are saying D is the continuously compounded dividend component. Why are we saying that? Because we're saying financial forwards tend to provide some element of dividends. If you're investing in financial contracts on stock indices, there is some component of dividend that you should be able to realize. So we need to remove out that component over there. Where we are saying, of course, we define what FT is, the spot price, the transcendental value. R, we've already said, is the risk-free rate. T is already the time is time component. And now where we'll define only what we've not defined. D is, you're saying, the constant dividend, continuous dividend. Continuous dividend there, like that. That is the only element that we need to describe. And in so doing, we now need to look at an example that can be able to highlight that component there. So the example reads as follows. The NSE 20 is currently trading at 1,555 shillings, and the risk-free interest rate is 4.5%. The current dividend yield on the NSE 20 is 2.2%. Calculate the forward price of a 6-month forward contract on the NSE 20. Now, we have already got all of the inputs. We just come over here. We can come on this other side, please, with your permission. So we already know FT solution. FT is equals to SE R minus D time there. So the spot price is how much? The spot price for the NSE 20 is 1,555, like that. And then we have the E, then the transcendental value. R minus D, we have the risk-free rate. I can see the risk-free rate is 0.045, 4.5%, 0.045 minus the dividend. The current yield is 2.2%, 0.022, like that. And then the time is how many months? I can see 6 months, so it's 6/12, like that. 6/12, like that. So we try and get what the value is. Just as the way we've done it, we first of all work out this component over here. We first of all work out the brackets. You remember board mass? Saying board mass. Like that, so brackets. So you work out what about that component is, or rather the entire component over here. 6/12 is 0.5. So we're saying we have 0.045 minus 0.022. Like that, 0.023. Then you multiply that, because there's a multiplication sign there, times 0.5. We have 0.0115. So you can put that 0.0115 on the side there, like that. Now, once we've worked out that, we just work out now the complete transcendental value. We said is shift E1, we're saying is 2.71828. Then we raise it to power 0.0115, like that. We have 1.011. That value you multiply by 1,555. So that multiplied by 1,555, we get how much? We get 1,572.99. You can see that. That is the forward price, like that. So that is how we are able to consider that. We are saying the financial, please note, the financial forwards represent or have to have a component of dividends there. If it's a treasury bond, there it may not be having maybe dividends. It could be some form of maybe return on investment of the interest rate. Please slot in that interest rate over here, like that, convert it into decimals so that you can be able to get the forward price, like that. Now, having looked at that, now we need to look at the arbitrage pricing right over here. We've already done that. Arbitrage free pricing of physical asset forwards. Arbitrage pricing of physical asset forwards. Physical asset forwards. Now, physical asset forwards are different from the financial forwards in the sense that financial forwards you may not physically touch, maybe say stock futures or maybe bond futures like that. But physical, that's the key word there that you need to look at. Physical, or what we're saying in the form of commodities, you can physically touch those commodities, is slightly different, but it builds on this concept over here. However, we need to consider the fact that there is some component of storage costs because you're dealing with physical commodities. For example, when you're talking about buying 100 or 1,000 bushels of wheat, when you want to buy that with the expectation that the prices will rise in future and the forward prices, then you need to consider where to store it, and as well you also need to consider a component of convenience yield like that. Now the component of convenience yield we are saying refers to the return that is earned from holding the physical asset, the return that is earned from holding the physical asset there. Now we just jump straight into looking at the model there. So we are saying that FT and that is given as S, E. We are still building on what we've actually done previous subsections. Then we have R, but now we add the component of the storage costs. So C, then you minus the dividend component. I'm just building on this one over here, and then we minus the convenience yield like that, and then which you're saying the convenience yield represents the return that is earned from holding the physical asset times T there. So we explain what has not been explained there, where I'll do it on this other side here. Where we are saying C, storage costs, for storing the physical asset, yeah, and then we're also saying Y is the convenience yield. That is, I can put it in brackets, the return from holding a physical asset. Like that. So you can see it builds on what we've looked at before previously, particularly like this one over here from financial forwards. There is no component of storage costs for financial forwards. There is no component of convenience yield for financial forwards. But for physical commodities, there, these two components right there need to be, especially the storage cost needs to be added, and then you remove the component of return from the physical commodity, so that you can be able to get the expected or the forecasted forward prices there. Now we look at an example right here, and the example is as follows. The current price of platinum is 1,419 shillings per troy ounce. The risk-free interest rate is 4%, and the cost to store in a warehouse is 2.5% of the purchase price. Platinum can be leased to jewelry dealers with a promise to repay the platinum at a later date. The lease rate is 1.5%. Calculate the price of 3-month forward contract on platinum. So we are going to have a solution right over here. That now we have FT is given as SER plus the storage costs minus the dividend component, and then minus the convenience yield, then times T. In this case, the T, we've already been given 3 months like that. So he's putting it all together. We have the spot price as 1,419. And E, we put the risk-free rate. We are told the risk-free interest rate is 4%, 0.04, plus the storage costs, and the cost to store platinum in a warehouse is 2.5%, so it's 0.025 then minus the dividend component. Do we have a dividend component? Remember what we're dealing with. We're dealing with a physical asset. There's no component of dividend, so that one does not exist. So we try and see if we have the convenience yield. I can see the convenience yield is 1.5%. That is what you're saying is the same as the lease rate. So 0.015. We close the bracket. T, we have how many months? I can see 3. So it's 3 over 12 there. Probably could be 0.25. Yes, should be 0.25. Yeah, so let's work it out, see how much we get. So we work out, remember as we said, we work out this part first of all. So it's 0.04, we add 0.025, then we less 0.015, 0.015, like that. Then we multiply by 0.25, like that. So we get that. Now we need to apply the continuous compounding component there. So we are saying shift E1, apologies, sorry, 0.0125, I write it over here, 0.0125, like that. So shift E1, like that, and then you get power 0.0125. So 1.0125. Now you multiply that answer by 1419. 1,436.85 shillings. That is the forward price there. Considering physical commodities there. Now this brings us to the end of this lesson. We hope that you have enjoyed the lesson, and we thank you so much, and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri, and I'll be taking you through alternative investment analysis. We are looking at commodities. In this final lesson on commodities, we will be looking at the following. We will look at traditional asset diversification, specifically, we will look at reasons for low correlation with stocks and bonds. Reasons for low correlation with stocks and bonds. Like that. So the reasons could be, the reasons are as follows: supply versus demand. Another reason is correlation with inflation. That reason, we will be looking at short-term versus long-term expectations. Now we will now move on and look at inflation and diversification. So another concept will be inflation and diversification. That. Then we will move ahead and have commodity investing. Investing without futures. How do we invest in commodities without the use of futures contracts? Yeah, and specifically we will look at investing in physical commodities. physical commodities. Then we will also look at commodity related equity investments. Equity. That. Then finally we will look at ETFs, exchange traded funds, like that. Then we will now concentrate now on futures return component. Is another one. Futures return components. Like that. That is what we are going to look at in today's lesson. And we are now going to start by looking at traditional asset diversification. So, traditional asset diversification. Now, traditional asset diversification will mean that you now need to try and allocate specific percentages, or you need to allocate the funds towards asset classes based on traditional techniques. But now when using commodities, it becomes a bit complicated, because we are saying that trying to seek exposure towards commodities would require either to invest in financial futures or in the physical commodity itself, like that. So now we can be able to mention something, that commodity prices should be lowly correlated or correlated to prices of stocks and bonds. Prices of stocks and bonds. That. Following reasons provide an explanation. So we can start by saying, number one, we are looking at these subsections over here. We are looking at the reasons for relation to stock bonds, supply versus demand. That, and we can say values of stocks and bonds are you can say they are driven by present value of expected cash flows. For example, for stocks, we are saying they are driven by the component of dividends. You expect to receive a rate of return at the end of any financial year. For bonds, we are saying the expected forces of demand and supply are the ones that are going to drive the prices or the values of bonds and like that. So driven by present value of expected cash flows, we are saying commodities do not have cash flows. Commodities do not have cash flows, like that, to discount but are instead driven by supply and demand interactions, saying the value of stocks and bonds are driven by present value of expected, what we expect the value of, say, the bonds there to be at the end of, say, 6 months is what is driven or what drives the price movements of bonds and stocks. But for commodities, since it doesn't have cash flows, they are driven by supply and demand interactions. There. Number two, we are saying correlation with inflation. Inflation. That correlation with inflation. This is what we are saying. We are just trying to follow what we have actually written down over here. And we are saying we have looked at supply and demand. We are looking now at this part over here, correlation with inflation. So we can say that inflation occurs. Inflation occurs. It occurs when the value, we can say the value of a currency, decreases in relation to we can say in relation to the purchase price or the purchase in relation to the purchase price. That we can continue on this other side here of a basket of goods and services. Of goods and services. Thus, we can say thus, increasing commodity prices, we can say increasing commodity prices are, we can say increase in commodity prices are assurance of inflation. Both changes in inflation and both changes in inflation and inflation are negatively correlated with prices of stocks and bonds. With prices of stocks and bonds. So what are we saying? We're saying correlation in inflation, it occurs when the basket full of goods and services actually increases in value. What 100 shillings could buy maybe in the year 1992 versus what 100 shillings can buy in the year 2017 is different. So the purchase, what 100 shillings could buy in 1992 is much more than compared to what 100 shillings can actually buy right now. So we are saying that means the purchasing power has reduced like that. And we are saying that increasing commodity prices are assurance of inflation, because if the commodity prices tend to go up like this, how much you would spend to buy a commodity would require much more money as compared to how much it would maybe say sometime in the past right there. Now let's look at the second component, or the third component. Now we are looking at short-term versus long-term expectations like that. So these are the reasons of why commodity prices are lowly correlated or should be negatively correlated with stocks and bonds. So now the third one we are saying is short-term versus long-term expectations versus long-term expectations. Like that. And what we can write under this, we can say that commodity futures prices are affected by short-term supply and demand expectations, while we can say while the prices of stocks and bonds like that reflect long-term cash flow expectations. Long-term cash flow expectations. Like that. So we are saying that futures prices are or tend to be affected by short-term supply and demand, and that is linked to this component which you had looked at in number 1 over here. While the prices of long-term, short-term, or rather the prices of stocks and bonds are affected by long-term cash flows. This one is affected by short-term supply and demand, whereas stocks and bonds are affected by long-term components of cash flow expectations. What do you expect the cash to be like in future, like that? That is what you're saying are the reasons why they should be uncorrelated, negatively correlated, or lowly correlated with the prices of stocks and bonds, like that. Now, having looked at the reasons for low correlation, we need now to move on and look at inflation and diversification right over here. That is our next component and our next focus, like that. So, inflation and diversification. Inflation and diversification. Now, inflation or money, the purchasing power of money becomes eroded as inflation increases. So, for commodities, as we have just seen over here, we are saying that inflation commodities would be a good inflation hedge because they are uncorrelated, lowly correlated, or negatively correlated to the prices of stocks and bonds, or to the values of stocks and bonds. So, including commodities in the portfolio would tend to reduce the component of diversification. If you allow me to come on this other side right here, what I'm saying is this. Is that when you include other asset classes, each investment has got a component of non-diversifiable risk. In it, like that, the risk that cannot be diversified. So we are saying that this graph, this is number of investments, moves like that. This is the risk. So the more if you invest, this is stocks. So for example, if you add both alternate investments, if you probably add commodities and the like that, you probably add other asset classes like that, the exposure of the portfolio towards risk will tend to reduce. Look at this side over here. We are looking at the risk component. as you add additional asset classes that are uncorrelated with stocks and bonds, then you're saying that the component of risk will reduce. It was initially there when you invested in one asset class, but because you're adding additional asset classes, it will tend to reduce from that component to that component, or to that value right there. So the overall value of the portfolio tends to be protected, and inflation does a good job towards that. So we can come over here and say the following. That inflation risk is the uncertainty of economic results caused by potential changes in the value potential changes in the value of a commodity, of a currency. I can say of a currency, not of a commodity. That is inflation risk. So we continue and say asset prices reflect expected inflation. Inflation rates. So commodities tend to provide protection in two specific ways. So that's what we need to identify. Commodities provide protection in two ways. Put a semicolon like that. The first way, we can say commodities are positively correlated. Correlated with inflation. So that means the moment you include commodities in a portfolio of asset classes, then it will tend to reduce the component of risk like that. And we are looking at this side over here with how much we are concentrating on the risk component or exposures towards risk. Notice we're talking about inflation risk like that. So when you include commodities in a portfolio, since you are saying that they are positively correlated with inflation, what happens is that including commodities will tend to reduce your exposure towards the risk, the inflation risk component like that. So that is what we're saying. It provides protection. The second way is that commodity prices represent value of consumption. So we are saying that it is probably is to a great extent based on the forces of demand and supply. We are dealing with physical commodities, for example, wheat, barley, like that. It is expected that they are going to be consumed in future, and hence we are saying that commodity prices represent value for consumption. How much am I paying so that I can be able to purchase maybe say a given commodity like that? So we are saying that inflation, this subtopic of inflation diversification, asset prices being reflected, rather asset prices, we are saying that reflect expected inflation rates. What are we expecting the inflation rates to be in future? So we are saying that commodity prices being a representation of values of consumption would be useful, especially when you try to seek exposure towards commodities with the intention of trying to reduce exposures towards risk, particularly inflation risk there. Now, having looked at that, we can now move on and look at something else. We can look at commodity futures, commodity investing without futures. There are three principal components. We are saying there is physical commodities, there is commodity-related equity investments, and there is exchange-traded funds. This is a particularly interesting area because we do not have this kind of investing in commodities. We don't even have a commodities market. Yes, okay, we may have a commodities market, and in the form of East Africa Tea Trade Association. That association deals with physical commodities, but they don't practice this commodity investing. It is pretty complex and for our market over here, but it is hoped that we can be able to have this kind of commodity investing methods there. So we say commodity investing, investing without futures. Without futures. So we are not going to use any form of derivatives for commodity investing. What we are going to do, we just want to physically purchase the commodity. If it's barley, if it's wheat, if it's copper, if it's gold, like that, we can be able to seek exposure to commodities without the use of futures by, number one, physical, we've written over here, physical commodities. Number one, physical commodities. So what you do is that you just go ahead and purchase a physical commodity, wherever it is actually being mined, if it's being grown, you just go and buy the physical commodity, and you'll be able to have exposure towards commodities. The second way of how you can be able to seek or perform commodity investing is, we have written it over there, commodity equity investments. Commodity related equity investments. Commodity related equity investments. Now, these commodity equity investments is that you can be able to get exposure towards the equities. Yeah, you can, if for example, this is a company, or the best way to explain it is on this other side right here. We're saying that this is a company right here, X. It deals with the extraction. This is probably maybe, say, the land that we are saying, or the rocky areas like that. It goes and extracts. It extracts the gold from where it is actually from the gold mines there. Once it extracts gold from the gold mines like that, how investors can seek exposure towards commodities is by investing in the shares of this company. Investing in the shares of this company will mean what? That if this company has floated shares on the exchange like this, investors over here, this is the exchange, that investors can come over here and consider and seek exposure towards the exchange, and now the shares have actually been floated like this to investors. So investors over here, including institutional investors, can be able to buy the shares of this company that has listed the shares on the exchange, and by extension, investors can be able to seek exposure towards commodities. So buying the shares of a company that directly deals with extraction of the commodity, or buying the shares of a company that deals in, say, the growing of crops, or maybe growing of wheat, barley, like that, then provides exposure towards investing in commodities like that. That is the way how you can be. You have not used any form of derivative instrument there. You're just using equity investments, so that you can be able to seek exposure. If the prices of gold increases, the prices of the shares of this company also increases like that by extension. The third way, right over here, come on this side. Third way, number three, we are saying exchange traded funds. It's actually right over here. This is the third way of how you can be able to seek exposure like that. This is exchange traded funds, ETFs. exchange traded funds. Now we are saying under exchange traded funds is where an exchange can come up with a fund here that concentrates on commodities. So investors can decide to invest in that fund. So these are dealing with commodities. It could be dealing with wheat, it could be dealing with copper, it could also be dealing with maybe barley and hops and something like that. So if you invest in that fund, then you somewhat indirectly seek exposure towards commodities. So those are the three ways how investors can seek exposure towards commodities. Very interesting, and we should be able to also have this kind of exchange or this kind of methods. We should be able to have a commodities market here in Kenya. Since we are agricultural based in Kenya, we should, or particularly maybe in the larger Africa, we should be able to have an exchange that deals with commodities. Now we look at this final subsection here that talks about futures return components. Futures return components. Return components. The futures return components, or how do you earn a return when you have invested in futures, is very important, so that we can be able to see whether the pros and cons provide significant benefit of investing in futures. So we are saying the first method right over here is the spot return. That is one of the return components in futures. So spot return, we are saying, reflects changes in spot prices, we can say of commodities, a commodity, due to demand and supply forces. So if the spot return changes from, say, 500 shillings to, say, 517, that is a spot return. So what I'm saying is that if the spot prices have changed from 500 shillings to 515 shillings, the difference of 517 minus 500 shillings, which is saying 17 shillings, that is a component of return for commodity investors. So that is what you're saying is the spot return there. Number two is collateral yield. Collateral yield. Now, collateral yield, we are saying, is the following. We can say is the interest earned on a risk-free asset. Purchased to collateralize. The face amount of the commodity. Face amount of the commodity commodity futures held for investment. That. So we're saying is the interest earned on the risk-free asset. So the risk-free asset is an asset that is risk-free. Probably maybe treasury bills is a risk-free asset, and that is purchased so that it can be able to collateralize the face value of the component of the commodity futures there. That is also a component of return for commodity futures position. That. The third component, number 3, we are saying is excess return. Excess return, we can say, is generated from from changes in futures prices. Changes in futures prices based on different maturities. Based on different maturities, like that. So you're looking at the return based on changes in. So you are looking at maybe say a futures that is dealing with that is maybe say 60 day futures contract. What is the value that is being given? It's XX, and you're looking at futures that is dealing on 90 day. It is giving Y like that. You can be able to get the excess return. The excess return like that is the difference between these 90-day futures and the 60-day futures like that. So those are the components of return, the components of futures return, and that brings us to the end of this topic dealing with commodities. And as usual, I will give you some assignment to try by yourselves. Please look at May 2017 question 3B and D. Please also look at November 2016 question 5C. Look at May 2016 question 3B and E. Look at November 2015 question 5B and C. And finally, look at November 2015 question 1D. This brings us to the end of alternative investment analysis. We hope that you have enjoyed the unit, and we also hope that you will also be able to view other videos for the CIFA qualification on Manifested e-learning forum. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Welcome to Manifested Publishers.
Welcome once more in derivatives analysis, and we are still in the subtopic called the types of derivatives, and we are saying that the types of derivatives are in three broad categories. One are the forward commitments, contingent claims, and the exotics. Now, we still have our discussion anchored on the forward commitment, where we said there are three subcategories. The forwards. Forwards are bilateral agreements, they are gentleman's agreement, and futures. Futures are standardized agreement that trade at the listed exchanges, whereas the forward trades are the over-the-counter markets. Then the third category, which is subject of our discussion, is still swaps. And swaps are just agreement between parties to exchange a series of cash flows. So here the exchange is on a series of cash flows. So contingent claims are predominantly options, and exotics, these are financial engineering products. Financial engineering products that call for non-standardized items and the combination of variations of various types of derivatives. So we say the types of derivatives can also come from the underlying. For instance, for swaps, we have that swaps Swaps predominantly derive their types from the interest rates, and here we have seen various even types of variation of interest rate, then exchange rates, and these exchange rates form our discussion today. And here in exchange rate, normally we say the exchange rate is the price of one country's currency with respect to another country's currency. Therefore, here predominantly the discussion will center on the currency swaps. And we have swaps, various types also, the various types on stock prices. And also we have swaps that also drive their value from the changes in commodity prices. Now, currency swap, forms the discussion of today's class. And what maybe do we say is a currency swap? Currency swap. Now, a currency swap is one in which parties, first of all, agree to exchange cash flows. So parties agree to exchange cash flows. Now, these cash flows are what? The interest and principal, the interest and principal, the interest and principal on one currency is exchanged for the interest and principal in another currency, for the interest and principal in another currency. Now, we are saying, for example, we may have us exchanging two currency. We may have interest and principal exchange or based on the US dollar currency. So here the principal plus interest are paid, and then they also exchange against the Great Britain pound. So we receive also interest and principal based on the Great British pound and the US dollar. Such would be a currency swap. Now, could we have currency swap variation? The answer is yes. So, currency swap variants. So, in a currency swap variant, number one of interest, which we can look at, is a fixed for fixed currency swap. A fixed for fixed currency swap. Now, here what happens is that the fixed rate of interest is specified in each currency. Fixed rate. So the fixed rate of interest is set in each of the currencies. So in this example of ours, exchanging principal and interest payment on USD for principal and interest payment in Great British pound, then we find the fixed side on the USD side and the fixed rate on the GBP side are determined and fixed at the start. So payment in one side are determined by applying a fixed rate. For example, the payment in the USD, yes, are determined by applying a fixed rate, yeah, to the USD principal, and payment in the GBP are determined by applying a fixed rate to the GBP currency. That is one of the variation of the currency swap. Now, the second variation is normally what we call floating for floating. So floating for floating currency swap. Now, with a floating for floating currency swap, the payment to one side apply maybe like the USD Liba. So the payment to one side applies the USD Libor. Yeah, so that is the USD currency. We apply a riba, and again, riba in our previous classes, we have seen that it is a changing interest rate on the undetermined frequency, and the payment to the other side, and payment to the other side applies the GBP Libor. So if such is the agreement between the parties, then what we will be having at the end of the day will be floating for floating currency swap. Then the third variation of the currency swap is what we normally call the cross-currency interest rate swap, the cross-currency interest rate swap. Now, what normally happens in this kind of swap, it is that the floating rate in one currency, so we have similarly the floating rate in one currency, floating rate in one currency is exchanged for a fixed rate in another currency. For instance, we maybe have the USD side is paying floating, right? And the GBP side is paying maybe now the fixed. Yeah, that now will be a cross-currency interest rate swap, and it is a variation of the currency swap. Then the other category of swaps will drive its value from stock prices, and this, when it does so, then the resulting swap is called an equity swap, an equity swap. So let's see what an equity swap is. Equity swap. So in an equity swap, we're saying one party promises to pay a return. So one party promises to pay a return on an equity index, on a notional principle. Notion of principle, we agreed we will be abbreviating it an NP, while the other party pays a floating or fixed return on a stated notional principle. On a stated notional principle. So therefore, what we are saying is that the equity swap allows people to pay a return that is based on an equity index. So what can we say is the importance of swap swap, or let's say swap on equities? We find out that these swap are very important in, number one, they enable the investment participants, practitioners, to increase or decrease, or decrease exposure to an equity, without purchasing stock. So we can get portfolio managers, we can get fund managers gain an exposure or rid of themselves an exposure in the equity index predominantly without purchase of stock. This is advantageous more so because also the transaction costs that could have been involved in paying maybe say a broker to be able to execute the trade of buying individual stocks that you want, and also considering the volumes that have to be met. Now, number two, we say that equity swaps are very important in that they offer convenience. In ways of purchasing a series, of fixed contractual payment on an index, payment on an index, to meet the needs of the various market practitioners. So to meet the needs of various market practitioners. So, like we have said in step one, in the importance number one, is that the investment practitioners can able to increase or decrease their exposure without necessarily owning the individual stock. This is also very important because they offer convenience, because you can buy not only one, cash flow, but now through a swap, a series of fixed contractual payment that also are linked to the equity index. And an equity index could be thought of like the Nairobi NSE, Nairobi Securities Exchange, or share index, for example. Instead of buying all the stocks in the all share index, that could be more than even 50 companies that are listed on that exchange. So therefore, it will be very convenient and also be able to meet the various needs of participants with that market. This, therefore, brings us to the end on the various types of swap instruments that we can have. And in the coming topics, for each topic, we have leeway to look at the various types still, and this is the introduction bit. And at that particular juncture, we'll be able to even explore more other options. So for today's lesson, the assignment will be B, explain any two advantages of equity swaps. The assignment for today's lesson will be explain any two advantages of equity swaps. The assignment for today's lesson will be explain any two advantages of equity swaps. Thank you.
Hi students, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, lecturer for Financial Reporting and Analysis. So in this session, I want us we continue with topic number 3 with a special focus on subtopic number 5 regarding presentation or preparation of financial statement by cooperative societies. But before you look on the financial statement which a cooperative society need to prepare at the end of the year, we need to know what is a cooperative society, why is a cooperative society formed, and so on. Now, a cooperative society basically refers to an association or an organization which is formed in order to promote the economic well-being of its members. Basically, what that means is that a cooperative society here is not formed in order to provide services or basically in order to sell some goods now to the members of the public with an objective of making profit. So meaning that a cooperative society here is actually formed in order to promote now the economic well-being of the members. So therefore you can say that a cooperative society yes, so therefore in that case you're saying that a cooperative society here will be formed will be formed in order to do what? To promote now the economic well-being of its members and not to provide services or basically to sell goods now to the members of the public in order to do what? To make profit. So mean that whenever, for example, maybe a number of individuals come together, they decide to form something like a circle. Basically, a circle is a good example of a cooperative society. And we know that those particular members will be forming that particular circle in order to make some savings. And if one of the member maybe require a small loan, then he can be able to come to that particular circle and be able to do what? To borrow that particular money. So meaning that the objective of forming that circle is to promote now the economic well-being, to promote now the economic welfare of who? Of the members. Now, whenever a cooperative society is to be formed, a cooperative society is formed and also registered in accordance with something called the Cooperative Societies Act. And basically, once a cooperative society has been registered in accordance with that particular act, then it is recognized as a legal entity, meaning that a cooperative society do have the same status just like a company. A cooperative society can be able to own property. It do have what we refer as a contractual capacity. It can enter into contract on its own name. It can sue or be sued. It can own property and so on. So therefore, a cooperative society do have the same status, just like what? Just like a company. It is a legal entity. Now, according to the Cooperative Societies Act, we have 3 types of cooperative societies which can be registered or which can be formed in accordance with that particular what? Act. So therefore, in this case, we can look on the different types of cooperative societies, types of cooperative societies, which may be registered in accordance with what we refer as the Cooperative Societies Act. Number 1, we have something called a primary society. A primary society. So when talk about the primary society, this refers to any cooperative society which is formed by individual members. And according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed by a minimum of 10 qualified persons. And actually, for a person to qualify to be a member of a cooperative society, according to the Cooperative Societies Act, such a person need to have attained the age of 18 years. Number two is that such a person must be a resident or basically must own land within the cooperative society's area of what? Of operation. And number three is that that particular person must be within the profession, within the employment within which now the cooperative society is operating. So mean that if, for example, a cooperative society is formed like a coffee farmers, for any person to qualify to be a member, then such a person must be a coffee farmer. So therefore, it is important to note that primary societies are those particular cooperative societies here, which we are saying are formed by individual members, members. And also we are saying that according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed, or basically it is formed by a minimum of 10 qualified members, or basically 10 qualified persons. Number two, we have something called the secondary cooperative society, or basically we can refer to it as the cooperative union. Cooperative union. In other terms, it can also be known as a secondary society or a secondary cooperative society. And this is a particular cooperative society which will be formed by two or more primary societies. So mean that members of two or more primary societies may come together and they decide to register now a certain cooperative society. That cooperative society now which will be registered, or basically which will be formed, then we say it is formed by a primary society. So therefore, cooperative union is that particular cooperative society which is formed by two or more primary societies, two or more primary societies. Number three, or the other type of cooperative society is something known as the cooperative union. So when talk about the cooperative union, this refers to that particular cooperative society which is formed at the national level, basically to promote the growth and the development of what we refer as the cooperative union. So therefore, it is formed at the national level. The objective of forming this particular cooperative society is to promote the growth and the development of cooperative union. A good example of this particular cooperative society in Kenya is what we refer as KUSCO. KUSCO basically is a cooperative society which is formed at the national level to be able to promote the growth and development of cooperative union. So we can say yes, so therefore, what we refer as a cooperative union. Okay, cooperative union, we can use the word Apex Society. Let's rename this. The appropriate name for that, sorry, should be Apex Society. Apex Society, sorry for that, not cooperative union. So therefore, Apex Society, we are saying, is a particular cooperative society which will be formed at the national level to be able to promote now the growth and also the development of what we refer as the cooperative union. So therefore, according to the Cooperative Societies Act, we have those three types of cooperative societies which may be formed and also registered in accordance now with the Cooperative Societies Act. Now, our main focus here, as the topic suggests, is basically preparation of a financial statement of cooperative societies. And therefore, which are the financial statements which are prepared by a cooperative society. So we can look on those corporate financial statements, financial statements, prepared, financial statement prepared by cooperative societies. Cooperative societies. First of all, it is important to note here that when we talk about the financial statements, we are talking of the final accounts which are prepared by cooperative societies at the end of the year to basically ascertain their performance, to ascertain their financial position. In this case, we have three final accounts, three financial statements which are prepared by the cooperative societies, and those financial statements include number one, what you refer as the income statement. Income statement, which is also known as a statement of profit or loss. And number two, we have what you refer as the appropriation account. Appropriation account. And number three, we have a statement of financial position. Statement of financial position. So these are the final accounts which any cooperative society need to prepare at the end of the year. So let's start by looking on what is an income statement and why a cooperative society need to prepare the income statement. So number one, we have the income statement which we also referring to a statement of a profit or loss. And as the name suggests, a statement of a profit or loss, or basically what you're referring to as an income statement, this one is prepared to determine the performance of a cooperative society. So mean that in preparing the income statement or the statement of profit or loss, basically what the cooperative society will be doing is basically comparing the income of a given financial year and what you refer as what? The expenses or the expenditures incurred during that year. Any difference between the two is actually a profit or what? Or a loss. So therefore you can say that this is prepared. It is prepared to ascertain financial performance. Financial performance of a cooperative society. Of a cooperative society. In other terms, we can say just prepare to ascertain the profit or loss of a cooperative society in a given financial year. So how do we prepare, or how is this statement of a profit or loss presented? So let's look on the format or the layout of what if as a statement of profit or loss. Statement of profit stroke loss. Automatically is the one is prepared for a certain year. Yes, so here always we start by recording incomes of the cooperative society. Incomes of a cooperative society. A cooperative society may have various sources of incomes, including things like investment income, and we prepare this account on using vertical format. So a cooperative society may be having something like investment income, things like interest on loans to members. So whenever a cooperative society gives members loans, like a SACCO, the cooperative society or basically the SACCO will charge some interest. That interest is basically what? An income. So also a cooperative society may be having the other source of income like entrance fees. If you are you want to join a cooperative society, you may be required to pay some fee. So these are some of the good examples of the incomes of a cooperative society, and then from there you get incomes, the total incomes, and then now to this we proceed and less the expenditures. Less the expenditures or basically the expenses of the cooperative society. And here we basically deduct now the expenses incurred by the cooperative society in a given financial year. This will include things like maybe salaries and wages to the staff, things like management committee allowances, So a cooperative society is managed by a top organ known as management committee. Things like the interest on members' deposit. Cooperative societies, mostly SACCOs, they pay interest which is based on members' deposit, because the SACCOs want to encourage members to continue saving with that SACCO. So at the end of each year, as a member, you are paid some interest which is based on your your deposit. So we take into account that. Then we also take into account other expenses like rent, etc. So we take into account all the expenses of the cooperative society, and we less that now from the total income. So whatever you get here is now the profit for the year. So that's how a statement of profit or loss or an income statement of a cooperative society is presented or is prepared. So next, let's look on what is the appropriation account and why an appropriation account is prepared. Yes, number 2, we have appropriation account. So as the name suggests, this is basically an account or a final account which is prepared by cooperative societies to show how the profit for the year is supposed to be distributed to the various stakeholders. For example, this account is prepared to show how much amount was paid to the members as dividends, and also how much amount was set aside as statutory reserve fund. Now, it is important here for you to note that under the Cooperative Societies Act, cooperative societies, mostly SACCOs, are required to set aside 20% of their profit as a statutory reserve fund. So therefore, that amount which has been transferred from the profit to the statutory reserve fund, in accordance with the Cooperative Societies Act, it is also shown in this particular account. And therefore, you can say that yes, so this one is prepared to show how the profit for the year was distributed to various stakeholders in form of dividend, in form of transfer to the statutory reserve fund, and so on. So how do we prepare this particular account here? So we can look on the format of the appropriation account. Yes, so in preparing the appropriation account here, always you start with that particular profit for the year, which was determined after preparing now the income statement. Profit for the year, that's what we start with always. And then to this, we proceed and we less dividends which were paid. So if there are some dividends now which were paid, we come, we less those particular dividends here. We also deduct the transfer to the statutory reserve fund. And in this case, I've said that the statutory reserve fund, the amount to be transferred to the statutory reserve fund, this one, according to the Cooperative Societies Act, is always 20% of the profit. 20% of the profit for the year. So the examiner may have given that particular information to you, but equally, if you're given a question for cooperative society, that information still is missing, you have to note that 20% is a must, that 20% of the profit for the year must be transferred to something called the statutory reserve what? Reserve fund. And then after deducting those two items, what we do is that we get now the retained profit for the year. The retained profit for the year. The retained profit for the year. To this retained profit for the year, we add the retained profit balance brought down. The retained profit balance brought down. This is the profit which was retained in the previous year. And then whatever you get down here is the retained profit, which is also known as the appropriation account balance. Appropriation account balance carried down. And this particular balance which we have here, this one will be transferred to the statement of financial position as a component of equity. So this one is transferred to statement of financial position as a component of equity. As a component of what? Equity. So basically that's how the appropriation account is prepared. You can see it is basically prepared to show how now the profit for the year, the profit which was reported during the year was distributed now to the various stakeholders. Finally, I want us to look on how we prepare the statement of financial position. So number 3, statement of financial position. Now, when talk about this one, statement of financial position, formerly known as the balance sheet, this one is prepared to show the financial position of a cooperative society at the end of the year. In other terms, this is a statement of asset, liabilities, and equity, and this one always has to be prepared based on something known as the accounting equation. So we can say that yes, so therefore this is a statement of cooperative societies assets, liabilities, and equity as at the end of the year. On the other hand, we can say that it is prepared based on the accounting equation. Yes, so therefore this one we prepare it based on the accounting equation. The accounting equation is an equation which states that assets are equal to capital plus liabilities. So let's look on the format, how we prepare a statement of financial position. And actually this one we abbreviated as SOFP, statement of financial position, which is prepared as at the end of the year. So always we start by recording assets. And when preparing a statement of financial position for a cooperative society, is not a must. There is no need of classifying the asset into non-current and current. Just like what the banks do, we record the asset of the cooperative society starting from those assets which are liquid. When talk about assets which are liquid, we are talking of asset in form of cash, and then followed by those assets which are highly liquid, those assets which can be converted into cash within a short period of time, and finally we record now the long-term asset like the PPE and so on. So therefore, we start by recording assets. In this case, I've said we don't classify the asset into non-current and what? Current. So on recording the asset, what is important here is you start with most liquid assets. And finally record long-term assets. So meaning that here We start by recording things like the cash and bank balance, cash and bank balance, and then next we record things like investments, investment. We also record things like loans to members, whenever something like a SACCO has given the member some loan, that is an asset the cooperative society expect the members to repay back those particular loan. And then you finally record the long-term asset, such as now the PPE, property, plant and equipment. So therefore I've said here no need of classifying the asset into non-current and current, and then from there get the total assets, Next, we record now the capital and the liabilities. And remember what I've said is that the cooperative society here do have the same status just like a company. So therefore for capital we record, or the capital, which is also known as equity. This comprises of share capital, things like members' deposit, and the reserves. So therefore, let's look on what we record under equity. So next we record equity. And equity, I've said that this comprises of share capital and reserves. So we record the share capital. We also have the members' deposits. So it is important to note that if maybe the cooperative society we are dealing with is something like a SACCO, members will have made some deposit with such a SACCO. But generally, as a member of a SACCO, you can't be able to withdraw that particular amount of money anytime you want. So you can only be able to get back that particular amount of money if now you do what? You want to quit from that particular cooperative society. So mean that particular amount of money which you have deposited with your SACCO remain with the SACCO. The SACCO uses that as capital, because mostly SACCOs use that money in terms of giving loans to members. And that's why you can see we are treating that as part of capital. As part of what? Capital. So we record other items of equity, like the statutory reserve fund, I've mentioned something to do with this. And then things like the appropriation account, and other reserves like the revaluation reserves, etc. Yes, so those are the various items of equity. And then get the total equity there. And finally record liabilities. Equally here, when recording the liabilities of a cooperative society, no need of classifying them into non-current and also what? Current. You just record all the liabilities here, which include things like things like creditors, the amount of money which is owed to the creditors, any accrued expense, etc. Yes. So record all those particular liabilities there, and then proceed. You get what? The total equity and liabilities. And whatever you get here is the total equity and liabilities. Always it must be equal to the total asset, simply because we prepare that statement of financial position based on the accounting equation, which states that assets are equal to capital plus what? Liability. So therefore, that's how we prepare or basically present this particular statement of financial position of a cooperative society. So that brings us to the end of that session. In our next session, still in this on this particular subtopic here, we are going to look on an illustration question regarding presentation or preparation of financial statement of a cooperative society. So see you in the next class.
Welcome to Manifested Publishers.
Once more, I welcome you to a topic which is under the derivatives analysis. We are still having the discussion on the types of derivative instrument. The types of derivative instrument. So these types, we have seen them being in three major categories. We have seen they are forward commitments, they are contingent claims, and also they include exotics. Now, with forward commitments, we said they are comprised of three major categories, the forwards. And these forwards are predominantly bilateral agreements that trade on over-the-counter exchanges, isn't it? Gentleman's agreement between parties. We have now futures. Futures, these are listed and they are standardized. Then we said that for forwards, these are highly customized. For the other category that we saw were swaps, and then swaps we saw they are agreement to exchange cash flows. Exchange cash flows. So the agreement to exchange cash flows. Contingent claims are predominantly options. So options that grant just the rights, but not the obligation, Yeah, to buy or sell an underlying asset at a price that is determined upfront. So with option, there is a payment of an option premium at the start of the contract. For our discussion today, we'll center more on exotics, where we said exotics are derivative instruments that are basically driven by the number of non-standard instruments. So exotics are non-standard in that they are great in number and means they are now customized. They are customized according to the individual requirement. They are predominantly traded on OTC market, and for them to be customized, this is the work of the financial engineers who customize it according to the needs of various parties. Now, for us to have a better understanding on exotics, then we could ask ourselves, what are the main reasons for the development of exotics? Now, exotic come in play because of four reasons. Reason number one is predominantly to meet genuine hedging requirements of the participants who require them. The other reason why exotics are developed is to meet the tax, legal, or even regulatory requirements of fund managers or corporate treasurers. So you find that different institutions at even different times, they may have different needs in terms of the legal requirement, in terms of the tax needs, in terms of even the regulatory needs, and therefore we will need to customize these needs uniquely to different corporate treasurers and fund management. Sometimes we do develop exotics so that we can have, they are developed to have a reflection, about future movements of market variables of interest. So we have said that portfolio managers, fund managers, corporate treasurers have unique needs. However, there are circumstances in which financial services practitioner may want to know what is the likely level or the movement in exchange rates. For example, within an economy, what is the level of maybe say interest rates? So when we develop exotics, depending on various personalized needs, then we may have a reflection about the future. The fourth need number 4, stems from the fact that some shrewd practitioners may want to structure exotics that appear more attractive to unwary fund managers. Maybe some fund managers are not interested, they are not keen on various aspects that are either available in the standardized market, then and there exists an opportunity to make a gain, yeah, depending on the information they want to overlook. Then dealers can structure exotics that even appear more attractive to them. Now, for us to be able to have an understanding of the types of objectives, first we will make a list of them first, and then in our subsequent lesson, we'll be able to explain them in detail. So the types of exotics. Now, the types of exotic, because we say there are a number of customized. We customize derivative instrument based on either the variation of an existing instrument or predominantly the combination. So these types will be driven by majorly two things. One is the forwards, and in the forwards, we are able to obtain the range forwards. The range forwards, we will see it later in our subsequent discussions. Then majority of exotic now stems from options. Now, with options, we may begin with something that we saw in our classes sometimes back, what we call compound options. Then we have what we call the break forward contracts. These are under options because they involve some variation of the forward contract. Then we have the chooser options. We have another category called the barrier options. We have also the binary options. We could have also the look back options. We could also have the Asian options. We could have also a category called options to exchange one asset for another. Options to exchange one asset for another, right? And also we could be having options involving several assets. Involving several assets. So these will be the types of exotic product which we will be looking forward to discuss in our next sub session. But for today's class, maybe we can revisit an example we normally did under options. We can have maybe a combination through compound options. So compound options as one category of exotics are what? So let us see compound options. Now, under compound options, these are generally or simply options on options. For example, we have categories. We have 4 categories. We have category number 1, call on call. Remember, in our discussion of options, we said option is a derivative instrument, right? That gives the right but not the obligation to the right holder. Now, there are 2 types of rights. There is the call right, which is the right to buy, and there is the put right, which is the right to sell. So if it's a call option, now the option holder is granted the right to buy an underlying asset at a price set today, yeah, for a period of time. So we can combine that right to buy with another right to buy. The second is the call on put, and we could also have the third category on put on call, and lastly the 4th category on put on put. So put is the right to sell an underlying asset. Yeah, so we could have a right to sell an underlying asset and combined with another right to sell that underlying asset. Let's see, for example, what we call an example on a call on call option so that we can have a deeper understanding. Now, for example, on a call on call, the first exercise date, so what you find that with options, compound options, is that they have 2 strike price and 2 exercise dates. So with compound options, we have 2 exercise dates and 2 strike price. The strike prices. So, or some books would say 2 strikes. For example, let's say we have the first exercise date. So we have a call on call, e.g. a call on call. And this call on call, we would have the first exercise date, the first exercise date given as T1, and the holder then is entitled to pay a strike price, maybe K1, to be able to obtain the call right. So the holder is entitled to pay the first strike price K1, the first strike price K1, so that he can receive the call, so as to receive the call right. So as you receive the call right. Now, once he does that, he can gain also some other rights. He can gain other rights, gain another right to buy the underlying assets for the second strike price K2, and this one now, and for the exercise date T2. Therefore, this call option can only be exercised on the first exercise date. The call on call can only be exercised on the first exercise date if the value of the option is greater than the first strike price. If the value of the option is greater than the first strike price. So this is an example that we can use to be able to understand a call on call. So a call on call, as an example, the first exercise date T1 is given to the right holder, whereby he is entitled to pay the first strike price K1 so that he can be able to receive the call right. In that also call right, he can gain another right to buy the underlying asset for the second strike price K2 and for the exercise price T2. So the call on call can only be exercised on the first exercise date, of course, if the value of the option is greater than the first strike price. So we say, like we saw in our discussion about options, options are only exercised if it is beneficial to the right holder. Now, this brings us to an end of our session. And for us to be able to understand the concept better, we may have our assignment. Now, in the assignment for this class, you are supposed to discuss the reasons as to why there is need for exotics derivative instruments. So the assignment, you are supposed to discuss the various reasons as to why there is need for exotic derivative instruments. Thank you.
Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us we look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us we go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of two brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following trial balance was extracted from the books of the society as at 31st of December 2021. We have a trial balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued rents, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number 1, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for $175,000 US and $115,300 US respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you're told market Safi and Mzuri brands on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those two coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we're given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1. And then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, I've said when translating the sales for the 2 coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account. That is on 15th of January 2022. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura Cooperative Society for the year which ended 31st of December 2021. Number 1, Safi Brad Marketing Account showing the profit and loss. Number 2, Mzuri Brad Marketing Account showing the profit or loss. And Part C, Statement of Profit or Loss for the year which ended 31st of December 2021. And finally, Statement of Financial Position. So as far as the first 2 accounts are required, Part A and Part B, whereby we are required to prepare the marketing account of the 2 coffee brands. We are required to prepare those 2 accounts basically to show the profit or the loss which was realized from selling these 2 coffee brands. And what we are going to do, we are going to take now the sales, the sales of the 2 coffee brand, which is given in the additional information number 1, and then there is some information which are given in paragraph 1 that this cooperative society is required to retain 20% of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1, and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%. Then we are going to less now the expenses, specifically relating to those 2 coffee brands. So we start with Part A. Part A of that particular question. We are required to prepare a Safi brand marketing account. Which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales. The sales from this coffee brand, and we are given that information in additional information number 1. We are told the sales from this coffee brand, that is a Safi, it was $175,000 US. 175,000 US dollars, because these sales are in US dollars. So what we need to do, we need to translate this into Kenyan shillings. I've said we are going to use now the exchange rate when the money was remitted out to the bank account of the cooperative society. The money was remitted on 15th of January 2022, in which case now the exchange rate was 100 shillings, which was equivalent to $1 US. So we multiply that with what? With 100, so that we get the final figure here. So let's get the final figure. So this is 175,000. 175,000 then times 100. So that will give us 17.5 million. Take into account our figures are in thousands of shillings. So that will be recorded there 17,500. Then what you are told is that out of these particular sales from these 2 coffee brand, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members, or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we list now the the expenses. So first of all, we have now to deduct amount due to members. Amount due to members, and basically in this case, we have said the amount due to members is 80%. Amount due to members. That amount due to members in our case we have said is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. 20%. So what is 80% of 80% of this? 80% of 17,500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, this amount should be equal to 20% of this. Maybe you can just confirm 20% of 17,500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and list now the expenses. We list the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand. And those particular expenses are given in the trial balance. I think the first item in the trial balance, we have the expenses associated with marketing and selling Safi. So we have marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860, and then we have processing wages, which is an amount of 900. Yes, an amount of 900. So wherever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee brand. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand. Marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings, and we are following the same format. We start with the sales of this particular coffee brand, and that is given in the additional information number 1, which was 115,300, but this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society. And this will give us 11, or that is 11,530,000. So just like what you have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, you have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained. The amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 23.06. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. To record them here. So we have marketing expenses. Marketing expenses, an amount of 150. And then we have processing materials. Processing materials, an amount of 320. And then we have processing wages. Processing wages, which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee brand. So what do we have here? We have an amount of 2306 minus 150 minus 320 minus 30. That gives us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. And these are some of the items which were marked as far as that part is concerned. And by doing that, you get now your three marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency, which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, This one will be recorded there as a liability because this is what the cooperative society was supposed to pay to the members. It had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. In part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the entire cooperative society. Remember what you have prepared in part A. Part B is prepared to determine the profit from marketing and selling the 2 coffee brand. So part C, we are required to prepare a statement of profit or loss, statement of profit or loss, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have 2 columns. And we prepare these by comparing the incomes of a cooperative society with the expenses. With the expenses, automatically we start with the incomes and then we less the expenses. So which are some of the incomes of this particular cooperative society? So even before we go back to the trial balance, because we know our cooperative society is responsible for marketing 2 coffee brands on behalf of the members, we know that from marketing of the 2 coffee brands, there was a profit of 1,100 from marketing and selling of Safi, and 1806 from marketing and selling of what? Muzuri. So that is the first source of income to this cooperative society, and that is what we bring here. So profit from the 2 coffee brand Safi, which is a figure of what? Of 1,100, and then we also have the profit from the other coffee brand, which is Mzuri, a figure of 1806. Then what we need to do, we go back to the trial balance, we take the other incomes of this cooperative society. It's important for you to remember all incomes have a credit balance. So when checking for incomes from the trial balance, you check the items on the credit side of the trial balance. So the items on the credit side, I think the first item, we have dividends from investment, dividends from investment. Dividends from investment is a figure of 470. Below that, we have accrued rent. Accrued rent, these are liability. Sundry creditors is a liability. Appropriation account, this is like the retained profit at the start of the year, which is not an income. Revaluation reserve is a component of equity. Statutory reserve fund is a component of equity. And then below that, we have entrance fees. This is still an income to a cooperative society. And these entrance fees is a figure of what? Is a figure of 300. Below that, we have share capital, members deposit. None of those is an income. Sundry creditors, bank overdraft. All those are items of liabilities. And I think finally we have interest on members' loans. Interest on members' loans. Members or interest on loans to members. Remember what you have said is that once a cooperative society give loans to the members, a cooperative society definitely will have to charge some interest. That interest charged by the cooperative society is basically what is an income. Yes, so I think those are the only incomes which we have. So then what we need to do is to get the total incomes. So let's add all those figures so that we get the total incomes. We have 1,100 plus 1806 plus 470 plus 300 plus 35 890 35,890. Okay. Yes, that will give us the total incomes of 39,566. Yes, after getting the total incomes, what do we do next? We proceed and we less now the expenditures. The expenditures of these cooperative societies, expenditures of the cooperative society. So here we have a number of expenses, and before taking the expenses in the addition in the trial balance, it is always advisable first of all deal with the expenses affected by the additional information. Let's go to the additional information. In the additional information, number one, I think we had information about sales of the 2 coffee brands. That has nothing to do with the expenses. Number two, the exchange rate that do not affect expenses. And then number three, we are told audit fees to be provided for. Audit fee to be provided for, that is an expense. But equally, because we are told this audit fee was provided for, it means that when the year was coming to an end, this audit fee had not been paid. Meaning that in our statement of financial position, there is a liability. So we have audit fee of 6 million, but remember all our figures are in thousands of shillings. And then number four, we are told staff salaries and wages amounting to 3.2 million had not been paid. So we have staff salaries and wages. So what we do, we take the amount which was not yet paid at the end of the year, which is 32, and then we add to this, we add the amount which had already been paid, and this is the amount appearing in the trial balance. So the amount appearing in the trial balance as a staff salaries and wages is a figure of what? Yes, is a figure of 2290. 2290. So we add the two figures, so that now we get the total staff salaries and wages for that year. So we have a figure of 3,200 plus 2290. So the total staff wages and salaries for that year is a 5490. So let's go to note number 5. Interest on members' deposit is to be provided for. Remember, in this case, you have said that interest paid to members based on their deposit, this is an expense. This is an expense. And equally, it is also important to note that this amount are not being paid. It's just provided for. So therefore, still in preparing our statement of financial position, this will be a liability. So I think we are done with that point. And then number 5 is all about the amount to be transferred to the statutory reserve fund. That is not an expense. So what that means is that we go back to the trial balance which you are given, and we pick now all the other expenses. It's also important to note that all expenses in the trial balance, they have a debit balance. So we check the items on the debit balance, on the debit column of the trial balance, that is. And I think we can start from where we have traveling expenses. That, I think, where we have the first expense. It is important for you to note that we have some expenses which relate to these 2 coffee brand, Safi and Mzuri, and because we capture those particular expenses here in preparing this particular account, we don't take into account those particular expenses. Those expenses specifically relate to Safi and Mzuri. What we are recording here are the general expenses relating to the cooperative society. So we have traveling expenses for staff and committee members, a figure of 80 and 100. And then we have bank charges. Bank charges, an amount of how much? An amount of 200. We have bank interest. Bank interest, which is a figure of 890. Then below that we have salaries and wages. We have already dealt with that here. And then we have committee education, that is the other expenditure. committee education, which is an amount of 1,000. Below that, we have committee seating allowances. This is committee allowance. We have committee. Okay, this is a committee's education. Committee's education, which is 1,000. Then we have committee seating allowances, which is a figure of 1110. And then we have printing and stationery. Printing and stationery. So printing and stationery, we have a figure of 2050. And then we have general meeting expenses. General meeting expenses, an amount of 500. Below that, we have members education. Members education. Members education is a figure of 1,500. And then below that, we have entertainment. Entertainment. Entertainment is a figure of 50. And then next, and finally, we have the legal fees. The legal fees, which is a figure of what? Of 400. So those are, I think, the various expenses which relate to this cooperative society. I hope we have not skipped any. Yes. So what then we need to do, we need to add all those particular expenses of this particular cooperative society so that we can be able to determine the profit or what? The loss for the year. So let's add all these particular expenses, starting from where we have audit fee, 6,000 plus 5490 plus 6086 plus 80 plus 100 plus 200 plus 810 plus 1,000 plus 1110 plus 2050 plus 500 plus 15 plus 50 plus 400. Yes, so that is giving us a total of 376. So what we need to do, we need to less that now from the total incomes which we have here. We deduct that from 39,566. So that will give us the profit for the year. The profit for the year of 14,190. So basically that is it, that what is required as far as that part was concerned. Preparation of the statement of profit or loss, and in that case now the examiner had given how many marks? The marks were allocated to that were six. So by recording those particular items of incomes and expenses, you had to get now 6 marks. So finally, let's prepare now the statement of financial position as required in part D of that particular question there. So we prepare statement of financial position. Statement of financial position. That is part D. You can just refer to it as abbreviated as SOFP, as at 31st of December 2021, 31st of December 2021. So remember, you say that it is a statement of assets, liabilities, and equity. So we just need to have a single column here. And we start by recording assets. And remember what we said in our first session. As far as this is concerned, we don't need to classify the asset into non-current and current. We just record asset starting from the most liquid to the long term. And I think we are given the asset starting from where we had our last expense, the legal fee. Below that we have cash in hand. Cash in hand. The cash in hand is a figure of 540. Then below that we have Wakulima Bank. Wakulima Bank Limited savings, which is an amount of 6780. And then we have still investment in Wakulima Bank Limited. Wakulima Bank Limited, which is a figure of 6,550. Then below that we have receivables. We have receivables from members, which is a figure of 2,960. We also have receivables from non-members, a figure of 22,500. And then we also have office equipment. Office equipment is a figure of what? Is a figure of 900. Yes, so I think those are some of the items which we have in the trial balance. But I think also below the various expenses relating to Safi and also Mzuri, we have now the loans to the members. Remember, we have said that once a cooperative society has given loans to the members, advanced loans to the members, these particular loans to the members to a SACCO or even to a cooperative society is an asset. The cooperative society expects now the members to repay back that amount of money. So basically that is an asset. Then what else do we have maybe from the additional information? From the additional information, number one, we have now the amount which this cooperative society was yet to receive from the marketing agency, which is Bora Limited. So we can just refer to that as the amount due. Amount due. This is the amount which was not yet remitted to the bank account of the cooperative society by the marketing agency, which is known as what? Bora Limited. And this amount, because it is given in terms of US dollars, we have now to convert that now to Kenyan shillings. So we take the sales from Safi, 175,000 US dollars. We can just take it as 175. And then from the other coffee brand, 115.3. And then we get the total. We translate that now to the Kenyan shillings by multiplying that with the exchange rate on the date the money was remitted. So we have 175 plus 115.3 times what? Times 100. So this is the amount of money which now Bora Limited was yet to remit to the bank account of the cooperative society. So therefore to the cooperative society, this is basically an asset. So that's what we have in note number 1. Additional information, note 1. Note 2 has nothing to do with the sales. Note 3 is that is a liability. Note 4, that is still a liability. And then number 5 is still a liability. And then number 6, this one will affect now the appropriation account. I'll be able to show you now the necessary what? Adjustment we are going to make as far as that is concerned. Yes, so what we need to do here is to get now the total assets. So let's add all these assets starting from where we have 540 plus 6780 plus 26 550 plus 2690 plus 22500 plus 900 plus 972 340 plus 29030 030. Yes, that will give us a total figure here of 1,061,330. So those are the total assets. Next, we record now equity. Equity, this one comprises of a share capital, members deposit, plus the various items of what? Of reserves, of which all these items, they have a credit balance. So let's start by recording the share capital of this cooperative society that is given in the trial balance. Share capital is given as a figure of 900. So then below that we have members deposit, which is a figure of 64 650. Yes, and then from there we have various items of reserves, starting with just above the share capital entrance fee, we have statutory reserve fund. This one will need to be adjusted because whatever you given there as a statutory reserve fund, this is a statutory reserve fund at the start of the year, and then what you are told as per note number 6 is that 20% will 20% of the net earnings is the same with the profit for the year, will be transferred to statutory reserve fund. So this should be 20% of what? 20% of this profit for the year. 20% of that what? Profit for the year. So it should be 20% of 14,190. So that we get the statutory reserve fund at the end of what? Of the year. So then below that, or basically above that, we have revaluation reserve. Revaluation reserve that remain the same, which is a figure of 750. We're going to compute that figure. And still we have appropriation account. Appropriation account, this account still, or this figure still need to be adjusted because what you're given there is the appropriation account at the start, which is what? Which is 50. To this, we should add the profit for the year. The profit for the year, remember, is 14,190, but equally we are going to less the amount which was transferred to the statutory reserve fund, which is 20% of 14,190. 14,190, and we get now the appropriation account balance at the end of the year. So I think we have picked all the items of equity. We have picked all items of what? Of equity. So I think what we just need to do here is to get now these final figures, starting with the statutory reserve fund. So let's first of all get 20% of this, 20% of 14,190 plus 13,740. That will give us 16,578. What about the appropriation account balance? So we have we have what? We have 6050 plus 14,190, and then to that we less what? We less 20% of 14,190, and that will give us 17,402. Yes. So those are the items of equity. So what we then need to do is now to get the total equity. Let's get the total equity by adding all these items. Actually, starting from there, we have 1742 plus 750 plus 16,578 plus 64, 650 plus 900,000. 900,000, which will give us 999,380. So that is the total equity. Total equity. So what we need to do next, or actually finally, we need to record now the liabilities. We need to record now the liabilities. We need to record the liabilities. The liabilities. So we have various items of liabilities. Let's start with what we have in the additional information. In the additional information, number one, there is something, first of all, you need to remember that there was amount due to members. There was some amount which was, this cooperative society was supposed to pay to the members, which was 80% of this amount, which was from the sales of the 2 coffee bread. So we can just compute that as 80% of this, 80% of 29,030. Although if you go back to what we prepared in Roman 1 and also all part A and part B, you can be able to see the amount due to the members as far as the sales of the 2 coffee brand is concerned. If you add those, the amount from Safi brand marketing account, Mzuri brand marketing account, should be able to get the same figure here as 80% of the total sales of the 2 coffee brand. So we have 80% of 29,030. That will give us 23,224. This amount which this cooperative society was yet to pay to the members. So that's what we have in note 1. Number 2 is about exchange rate. Number 3, we have provision for audit fee. For audit fees, this amount was not yet paid. It was just provided for. So therefore, it is a liability, 6,000. And then number 4, we have accrued salaries and wages. Accrued salaries and wages is 3.2. And then below that, number 5, we have provision for interest on members' deposit. Members' deposit. Still, this amount are not being paid. It was purely provided for. That's why we are accounting for it as a liability there. I think with that, what we have. Yes. So let's then go back to the trial balance and we pick now the other items of liabilities. Remember, all our liabilities, they have a credit balance. So starting from where we have dividend from members, below that we have accrued rent. Accrued rent, which is 470. Below that we have salary provision. Salary provision 4950. 4950. And then down there we have salary creditors. Salary creditors, which is a figure of 3410. And then we also have a bank OD, bank overdraft of 6150. 6150. Yes. So I think we have recorded all items of liabilities. None of the item which you have not recorded. None of the item which you have not recorded. Yes. So what we just need to do here is now we get the total. We get the total equity and liabilities. So for the total equity and liabilities, we take the total equity there and then we add all these items of liabilities. But let first of all we add these items of liabilities. We have 23,224 4 plus 6,000 plus 3,200 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes, plus what we have there is 999 380. Okay, let me take that again. Okay, so we have what? We have 999 380, and then we have 23,224 plus 6,000 plus 32 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes, so that is giving us the same figure there as 10 61 330. 10 61 330. So basically that is what was required in that part D of that question. These are the items now which were to be marked. The items to be marked, but definitely that particular statement of financial position, as you can see, there are so many entries. Entries, and basically by doing that, you are allocated 8 marks as far as that question is concerned. So that brings us now to the end of that particular illustration as far as the preparation of financial statements by cooperative societies are concerned. And I think that is the most recent question on cooperative societies. There is another question which was tested back in the year 2010. So if you can be able to access the past papers for 2010, you can be able to check a question which was tested. So I think was question number 4 from that particular sitting. So therefore, we stop at that particular point. See you in the next session as we move to a different topic. Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number 1, we have the horizontal structure. Number 2, we have the vertical structure, and also number 3, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, two or more subsidiaries. So the parent company here is having direct shareholding in two or more subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries, B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is the vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary in a subsidiary company, and also indirect shareholding, and also indirect shareholding in a subsidiary, in a subsidiary, subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a subsidiary. So what do you mean by that? Let's assume that we have three companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be or which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the subsidiary, subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know, and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. In the subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary, or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the subsidiary. Number two is you need to identify the date, identify the date when the subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group, became a member of the group, became a member of the group. And basically that particular date is very, very important because when, for example, preparing number one, when computing the goodwill of the subsidiary, you compute it on this particular date when the subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the subsidiary became a member of the group. And actually the subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the subsidiary. So therefore you can say that the subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the subsidiary. So basically we are saying that the subsidiary will become a member of the group on the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that you're told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. Therefore, in this case, we are saying the subsidiary will be deemed to have become a member of the group on the later of the two dates. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the subsidiary became a member of the group, of which you have said it must be the data of the two dates. So the other important point number 3, point number 3 is regarding the cost of investment, cost of investment in the subsidiary, cost of investment in the subsidiary. So when talk about the cost of investment in the subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the subsidiary. In acquiring the shares of what? The subsidiary. Now, this particular cost of investment in the subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, investment in subsidiary in sub-subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is the parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
Greetings you all and welcome to the study of business and data analytics. Business and data analytics is a newly introduced paper in the CPA syllabus. In our today's lesson, I'm going to do an adumbration of the CRISP DM framework. The CRISP DM framework. Now, learners, the CRISP DM framework is a model that serves as a base for a data science process or project. And CRISP stands for cross, CR stands for cross industry, this is cross industry standard, S stands for standard. All right, CR stands for cross, I stands for industry, S, this S stands for standard, all right, P stands for process, DM stands for data mining, cross industry standard process for data mining. It is a process for data mining. So what is data mining? Data mining is the process of extracting and discovering patterns in large data sets. Data mining is the process of extracting and discovering data patterns in large data sets. All right. So, candidates, the CRISP DM framework, I've said, is a cross-industry standard process for data mining, which is a model that serves as a base for data science. Data science. What is data science? Data science. Now, data science is the field of study that combines domain expertise, programming skills, and knowledge of mathematics and statistics to extract meaningful insights in data, meaningful insights from data. In other words, data science is a process of finding anomalies, finding patterns, finding correlations within larger data sets to predict outcomes. And using a broad range of techniques, you can use such information to increase revenues, to cut costs, to improve customer relationships, to reduce risks, and so on. Data science. And one may ask, what's the distinction between data science and data analytics? Because remember, our subject is data analytics. What's the difference between data science and data analytics? Now, candidates, while Data science focuses on finding meaningful correlations between large data sets. Data analytics, on the other hand, is designed to uncover the specifics of the extracted insights. In other words, data analytics is a branch of data science that focuses on more specific answers to the questions that data science brings forth. So, data analytics is a branch of data science. Is a branch. There are many branches of data science. So, data analytics is one of the branches. So, learners, in this lesson, I'm just doing an adumbration of the CRISP-DM framework, the cross-industry standard process for data mining. And I've defined data mining as the process of extracting and discovering patterns in large data sets. This CRISP industry standard process for data mining is a process model that serves as the base for a data science process. It's a process. It is what? It is a process. That means there are steps or stages or sequences or phases in the process we are calling cross-industry standard process. Cross-industry standard process. It is a process. And within this process we have sequential phases. Sequential phases in the cross-industry standard process. There are sequential phases. And these are the sequential phases, the phases or the steps, all right? The phases or the steps. It has various steps which include one is business understanding. Business understanding. The second phase is known as data understanding. The third phase is known as the data preparation. Data preparation. Number 4, modeling. Modeling. Number 5, evaluation. Evaluation. And lastly, deployment. Deployment. These are the phases in the cross-industry standard process. 1, business understanding. 2, data understanding. 3, data preparation. 4, modeling. 5, evaluation. 6, deployment. Now I'm going to briefly explain the 6 phases, starting with the business understanding. Business understanding, candidates, involves understanding the business domain, being able to define the problem from the business domain perspective, and finally being able to translate such business problems into data analytics problem. first understand the business. Define the problem from the business perspective. And there are various activities that take place in the process of understanding the business. Then number 2, data understanding. This involves collection of the necessary data and their initial visualization. It involves summarization of data in order to obtain the first insights, particularly and not exclusively about data quality problems. Understand the data. Does the data have any missing outliers? Find ways of understanding the data. And there are various activities that take place here. The third phase is known as data preparation. Data preparation, on the other hand, involves preparing the data set for modeling tool and may include data transformation, feature construction, outlier removal, missing data, may also include incomplete instances removal and so on. Data preparation. And candidates, there are various activities that take place when preparing data for analytics. Number 4, modeling. Modeling. And typically, there are various methods that can be used to solve the same problem in analytics, often with specific data requirements. And as the first step in modeling, you will have to select the actual modeling technique that you will use. You may choose techniques like decision trees. You may use techniques like neural network, neural network, and so on. Modeling. These are tools, techniques that can be used to solve the problem. Step number 5, evaluation. Evaluation is the next phase. All right? Solving the problem from the data analysis point of view is not the end of the process. It's not the end. When you come with the technique, that's not the end of the process. Why? Because it's necessary to understand how its use is meaningful from the business perspective. In other words, does the solution obtained, does that solution help meet the objective of the business? Because remember, in step number 1, we talked about business understanding, and it may be important, it is important at this step to come up with the objectives of the business. So the tools that are developed here, does the tool help meet the company objective? So that's very important to carry out evaluation. Then lastly, we have deployment phase. Deployment phase is the integration. At this point, we have the integration of the data analytics solution in the business process, which is very critical. The integration of the data analytics solution in the business process, we know, is the main purpose of the deployment phase. And typically, it implies the integration of the obtained solution into a decision support tool. Decision support tool. All right? You integrate the solution into a decision support tool, because we know the purpose of analytics is to extract and discover patterns in the large data sets so that the management can use such information in making informed decisions. So this is the cross-industry standard process for data mining. It is a process, and this process we can, in conclusion, illustrate it in a diagram. Beginning with business understanding. We have business understanding. Business understanding. We've talked about data understanding. Data understanding. There is data preparation. Data preparation. Then we have modeling. Modeling. Evaluation. And deployment. Business understanding, data understanding, business understanding, data understanding, data preparation, modeling, evaluation, deployment. Can have the arrows. It's a process. This is a process. This is a diagram to illustrate the cross-industry standard process for data mining. And that effectively brings this lesson to an end, where we have done an adumbration of the CRISP-DM framework, which we've said is a process for data mining. We've defined in this lesson data mining. We've defined data science. We've highlighted the distinction between data science and data analytics. Then we have briefly described the 6 phases in the cross-industry standard process for data mining framework. Number 1, business understanding. Number 2, data understanding. Number 3, data preparation. Number 4, modeling. Number 5, evaluation. Number 6, deployment. In closing, we illustrated the CRISP-DM model using a diagram, which you can see is a process that flows from the first phase, which is business understanding. The second phase, data understanding. The third phase, data preparation. The fourth phase, modeling. The fifth phase, evaluation. Then lastly, the deployment phase. So that will mark the end of the lesson. And as it is our tradition, I'm going to give you an assignment. Assignment: define data mining. 2. Using a diagram, describe the CRISP-DM framework. Thank you for attending the lesson. I hope to meet you in our next session. Goodbye.
Hello students, welcome to Manifested Online Classes. My name is Joseph Kimani, a senior lecturer in financial reporting and advanced financial reporting. So today I want us to look on the paper which was tested in the April 2022, and the paper is advanced financial reporting. So we have already done question number 1, 2. So I want us to proceed to question number 3. And this particular question here basically had 3 parts. So part A was from IFRS 15, revenue recognition. Part B was about employees' benefits. And the other part C was concerning the earnings per share. So I want us to start with part A of that particular question, which was a theory question. And it reads, with regard to international financial reporting standard IFRS 15, which deals with revenue revenue from a contract with customers, explain the key factors that should be considered when determining the transaction price within a contract. Within what? A contract. So this particular question was requiring you explain a number of factors which are supposed to be considered by a company in determining the transaction price as provided under IFRS 15. As provided under IFRS 15. So the question there, part A, was requiring you highlight key factors, that must be considered, or key factors to be considered, in determining the transaction price. The transaction price. Now, first of all, here, when talk about the transaction price, this refers now to the amount of money, or basically that particular consideration which is supposed to be paid by a customer once the goods have been delivered to such a customer, or once the services have been provided to such a customer. Now, which are some of the factors which are supposed to be considered in the terms of determining this transaction price which is now to be paid? So we have a number of factors which are supposed to be considered, and one of it is what you refer as the performance obligation, obligation to be satisfied. Performance obligation to be satisfied. So in this case, when talk about the performance obligation to be satisfied, we are talking of the goods which are to be delivered to a customer, or services which are to be provided to such a customer. That is the first thing the company should be able to consider in terms of determining the transaction price which is supposed to be paid by such a customer. Now, the other factor which also need to be considered is what we refer as the variable consideration. Variable consideration. In this case, when talk about the variable consideration, this is a consideration, or basically is that particular price which is not fixed. which is not fixed. So basically what that means is that this particular price is dependent on a number of things which are likely to happen in the future. So in other terms, we can say that this particular consideration is what is contingent, and therefore in this case, the company, what will the company need to do here is to estimate this particular variable consideration, because you are saying that this particular consideration will depend with a number of what factors. So therefore, the company, in determining the transaction price to be charged, it basically need to estimate that particular word variable consideration. Number two, or the other factor which also need to be considered here, is what refers the non-cash consideration. Non-cash consideration. Now, what is a non-cash consideration? This is basically that particular consideration which is to be paid in other means other than cash. Other than what? Cash. For example, the customer may promise to pay a consideration which is in form of other asset other than what? Cash. So what the company should be able to do is to estimate the value of this particular consideration, of which IFRS 15 requires that the company should be able to estimate the value of such consideration using the fair value of the non-consideration to be given by who? By the customer. To be given by who? By the customer. And finally, number four is what refers the consideration payable by the customer. Consideration payable by the customer. So this is the other factor which will need to be considered. So before the company can be able to arrive at the final figure of the transaction price, the company should be able to determine how much is that consideration the customer will pay after the goods are delivered, or basically after the services have been provided. So therefore, what the examiner here was requiring is you highlight at least two factors, which now will need to be considered by the company in terms of arriving at that transaction price, and basically for each you get 2 marks. So let's move to the other part, that is part B of that question, and this came from the topic of employees benefit, which reads: the following accounting information was extracted from the financial record of Kibo Limited regarding the defined retirement benefit scheme for its employees. So what you are given, one, here we are given the net defined benefit obligation as at 1st January 2021. So we are also given the net defined benefit obligation as at 31st December 2021. We also given the current service cost there, which is 200 million. We have the contribution to the scheme, the benefit paid by the trustee. Remember, the trustee here is a retirement benefit scheme. For example, when talk about NSSF is a trustee. So then you are told the market yield on high quality corporate board is at the rate of 5%, and then you're told assume there is no tax implication regarding the retirement benefit obligation. So from that information, what the examiner was required is, with suitable calculations, explain the accounting treatment of the various items of the defined benefit scheme on the financial statement of Kibo Limited for the year which ended 31st December 2021 in accordance with the IAS 19, which governs the employees benefit, So what was required here is, using suitable calculations, we explain some of the accounting treatment, or basically the accounting treatment of various items in the financial statement of Kibo Limited. So this is part B of the question, which was requiring we explain treatment of various items in financial statements of Kibo Limited, Limited. Now, in this case, we have a number of items which are supposed to be determined and accounted for in the financial statement of Kibo Limited. Essentially, there are three items. Which are those items? One, we have something called the net pension cost. The net pension cost, of which this net pension cost, this is supposed to be taken to the income statement as an expense. So the first item here is the net pension cost, net pension cost. And the other one is something known as the net actuarial, gain or loss. And number three is what we refer as the net defined benefit. Net defined benefit, we can just refer to this as net defined benefit, asset or liability. So these are the three items now which now a company which is operating a defined benefit scheme should be able to compute and basically account for in the financial statement at the end of the year. Now, first of all, this net pension cost, this one is accounted for as an expense. This one is accounted for as an expense in the income statement. Whereas this net actuarial gain or loss, this one is accounted for as part of other comprehensive income. Remember here, when talk about other comprehensive income, we are talking of other items of incomes or expenses, or items of incomes or expenses which should not be included as part of the profit or loss for the year. And then this net defined benefit asset or liability, this one should be accounted for in the statement of financial position as an asset. If the company has determined this and the company has gotten the net defined benefit asset, this one is accounted for as a non-current asset, whereas a net defined benefit, we have said this should be net non-current asset, whereas a net defined benefit liability is accounted for as a non-current liability in the statement of financial position. So therefore, what we need to do, or what the examiner was requiring as far as that question is concerned, is you compute these three items and basically you also explain how they were supposed to be accounted for in the financial statement of Kibo Limited. So therefore, let's compute these three items, and I think we can start with the second one here, that is the net actuarial gain. After computing that, then we proceed. We compute the net pension cost and then the net defined benefit asset or liability. So let's start by determining this. We can just refer to it as, we refer to this as net actuarial gain or loss. Net actuarial gain or loss. Now, how do we determine this particular net actuarial gain or loss? To determine this net actuarial gain or loss, there is the formula or the approach now which we use to compute this one. That is what you are supposed to remember. So to compute this one, remember our figures there are given in what? Are given in million of shillings. So we need to have a single column here. And what we start with here is what is known as the net defined benefit obligation. Balance brought down. So in this case, when talk about the net defined benefit obligation balance brought down, this is the opening balance, or basically what you're given there as the net defined benefit obligation on 1st January 2021, which is given as 1850. As 18 what? 50. Now to this, what do we add? To this we add something called the net interest cost. The net interest cost. Now this particular net interest cost we computed based on the rate which you are given there. If you go back to the question in the last paragraph there, we are told the high or the market yield of high quality corporate bond is at the rate of 5%. So in this case we take 5% of the net defined benefit obligation at the start. So we take 5% of 1850. So we get 85%. That is 5% of our net defined benefit obligation at the start. So 0.05 times 1850. So which will give us 92.5. 5. And then to this, what do we add? To this, then we add what we refer as a service cost, or what in other terms we refer to as the current service cost. The current service cost. The current service cost in our case here given that is an amount of 200 million. And then to this, after adding those two items, what we less here, sorry, not we less. Yes, so what are we given there? We are given the contribution to the scheme. So we need to take into account that here, the contribution to the scheme, of which this contribution to the scheme, automatically this one should be what? Should be deducted. How much is that? Is 225. 225. Now what you need to note here is that if we are using this particular approach here of computing the actuarial gain or loss, whereby we are using the net defined benefit obligation. Remember, the net defined benefit obligation is the net amount of what we refer as the plan asset and the plan obligation. So if you're using this particular approach to determine the net actuarial gain or loss, we don't less the benefit paid here, because the benefit paid are deducted from both the plan asset and the plan liability. So that one should not be deducted here. But if we were to use now the other approach, whereby we compute the actuarial gain or loss in respect to a plan asset separately, and the actuarial gain or loss in respect to the plan obligation separately, remember we have to deduct the benefit paid. But when using this particular approach here, I've said we don't less. We don't do what? We don't less those benefits are paid. The benefits paid are not supposed to be what? To be deducted there. Are not supposed to be deducted there. Then what we need to do is to get what we refer as the expected net defined benefit obligation at the end of the year. So we take 1850 plus 92.5 plus 200, that is minus 225, and that will give us a 17.5. Then what we need to do to this is we need to compare it. We need to compare this with the net defined benefit obligation at the end of the year. And this is the amount which are given as 2,000. So basically we need to compare these two, and remember that a net defined benefit obligation is essentially a liability. So basically what this means is that the company expected that the defined benefit obligation, the net defined benefit obligation, to be 1970. This is expected. The expected net defined benefit obligation, but you can see based on the actuarial valuation which was done at the end of the year, the net defined benefit obligation at the end of the year was determined to be what? 2,000. So basically we can say that there is an increase here in the value of liability. How much is our increase? We get the difference. The difference here is 82.5. 82.5, and because this is an increase, and also we have said that this is a liability, anytime the value of a liability increases, then that automatically is a loss. But in this case, remember, we are going to refer to this as what? as the net actuarial. The net actuarial, we have seen this is an increase, and basically take into account this liability. This therefore will be what? Will be a loss, because anytime the value of liability has increased, automatically that is what? Is a loss. Now this particular loss, or this net actuarial loss, is what you have said was supposed to be accounted for as part of other comprehensive income. So therefore we can go ahead and basically we give that particular explanation, because that's what the examiner was requiring. We say that the net actuarial loss, the net actuarial loss of shillings 82.5 million was supposed to be accounted for, or supposed to be accounted for as part of other comprehensive income, as part of other comprehensive what? Income. So that is the explanation which was required here, that the net actuarial loss, this figure which you have computed here of 82.5 million was supposed to be accounted for. This one was supposed to be accounted for as part of other comprehensive what? Income. Remember, you have said that the other comprehensive income, these are basically other items of incomes or expenses which should not be part of the profit, or these are incomes or expenses for the year which should not be part of what? The profit or loss for the year. Now, having determined that, we can proceed and we determine this net pension cost, net pension cost. Now how do we determine this particular net pension cost? How do we determine this net pension cost? So to compute this particular amount of net pension cost, equally we take a number of items here. We take a number of items. One, we take this net pension cost. This net pension cost, net pension cost, how much is that? That is an amount of 92.5. This is an item of expense. We also add the current service cost. Current service cost. How much is that? Is 200. And basically these are the only two items now which we take into account. But remember, when computing this net pension cost, in the event you are given the plan asset and the plan obligation separately, here you ordinarily have more items, because like in this you should be having something called the interest cost and something called the expected return on plan asset. Now this net pension cost is a net amount of those two items, interest cost and the expected return on plan what? Asset. Then you should have the current service cost. Already we have that. The past service cost, in our question we don't have the past service cost, because there was no improvement which was done by this company. The company has not increased those pension to be paid to the employees in what? In the future. Essentially there we should have around 4 items. I've said we don't have the past service cost, and then I've said that the net pension cost take into account the two costs. Take into account the two items, interest cost and the expected return on plan asset. So therefore, the net amount here, which is 292.5, this was supposed to be accounted for as an expense in the income what? Statement. So therefore, we can give that explanation here. The net pension cost, was supposed to be accounted for, as an expense, as an expense, and specifically this net pension cost, because this is an employees related expense, it is accounted for as administrative expense in the income statement, supposed to be accounted for as an expense in the income statement or statement of a profit or loss. Statement of profit or what? Or loss. Statement of profit or loss. So therefore, that is the explanation which was required there. You explain that net pension cost of basically 292.5 million. This one was supposed to be accounted for as what? As an expense, specifically administrative expense in the statement of what? A profit or loss. Finally, what we need to do is we compute the third item here, the net defined benefit asset or what? Liability. This is quite straightforward because the two items to be used here are given there. So let's compute that. The net defined benefit, asset or liability, benefit asset or liability. So how do we compute this? So to compute this one is quite simple and straightforward. Yes, so here we need to take into account only a single item which is already provided for us in this question, and that is now the net defined benefit obligation. Now this net defined benefit obligation at the end of the year is what was supposed to be taken to the statement of financial position of this company, and because it's a net obligation, that amount was supposed to be accounted for as what? As a non-current liability. And how much amount is that? The amount there is 200 million. Now this that is 2,000 million. Now this 2,000 million was supposed to be accounted for by the company as what? As a component of non-current liabilities. As a component of non-current what? Liabilities. So I think we can equally give that explanation here. We can give this explanation here, and we say that the net defined benefit liability, at year end is a non-current liability, in the statement of financial what? Position. Is a non-current liability in the statement of financial position. So therefore this was supposed to be accounted for, or basically to be taken to the company statement of financial position as an item of what? Non-current liability. As an item of non-current what? Liability. So therefore that is it, that what was required by the examiner there. So the examiner basically required you to compute those three items: the net actuarial gain or loss, the net pension cost, and the net defined benefit obligation, and basically you explain how they were supposed to be accounted for. So that brings us to the end of our class. So we come back and then we look on the other part of that question.
Hello and welcome back. Today I'm moving to answer question number 3, Advanced Financial Management, the paper that was done in April 2022. Question 3A, I read, Modigliani and Miller suggested that real-world considerations, primarily institutional constraints on high leverage, would prevent firms from approaching 100% debt levels required. Giving reasons, explain whether you agree with the above statement. Question 3A. April 2022, question 3A. Reasons. So, is it true that, the question is it true that firms would be prevented from approaching 100% debt levels? We know that debt is a cheap cost of finance to most companies. The question is, if debt is cheaper than the other sources of capital, then why is it that most companies' capital structure do not contain 100% debt finance? There are reasons why that is the case. Giving reasons, explain whether you agree with the above statement. I agree with the above statement, and these are the reasons. The first reason why companies do not have 100% debt levels is because of the debt covenants. All right? Debt covenants. Number one, debt covenants. Debt covenants. Now, lenders may restrict a company through debt covenants, resulting to decision inflexibility. Before a company borrows, there could be a condition that the leverage of a company be, say, 50% or less. That is a restriction. Before you get more funding, financial institutions would want to check your leverage level before they advance more debt. So that could be the one reason why companies do not have 100% debt levels. The second reason is that is in relation to risk. Risk. Now, the managers that are risk averse may be reluctant to borrow more debt. Risk averse managers. Risk averse managers may be reluctant to do what? To borrow more debt. We know some managers are aggressive, they will go for more debt, but others could be risk averse, they would avoid debt. So that, because of that attitude of being risk averse, then that can limit companies to have 100% debt levels. The other reason may be in relation to the lenders. Lenders may also be reluctant to lend too much. Why? Because the company becomes riskier as more debt is borrowed. The lenders may be reluctant to lend too much debt, since company may become riskier when more debt is borrowed. So these are reasons. Any two would earn you the 4 marks. Any two reasons here, 1, 2, would earn 4 marks. Now, moving on to part B of the question. Part B reads, An unlevered farm operates in a perfect market and has a net operating profit of 4 million shillings. The required rate of return on assets of this farm is, in this industry, is 16%. Assume that the farm issues 10 million shillings worth of debt with a required rate of return of 14.5% and uses the proceeds to repurchase outstanding shares. There are no corporate or personal taxes required. Roman 1. The market value and required rate of return of this firm's shares before the repurchase transaction according to MM proposition number 1. 2 marks. Part B. Roman 1. We are to calculate the market value of this firm and the required rate of return, 2 things. So the market value of the firm, we know the formula is EBIT over the cost of equity. EBIT over the cost of equity. And this is the cost of equity of the unlevered farm. This farm is unlevered. All right? And therefore, the earnings before interest and tax is 4 million. The cost of equity is equal to the required rate of return, which is 16%, 0.16. So that will be the market value of this firm. 4 million divide 0.16. It's 25 million. That is the market value of this firm. The next requirement is the required rate of return. The required rate of return of these farm shares before the repurchase. The required rate of return. The required rate of return. The required rate of return. The required rate of return of the farm shares. The required rate of return of the farm shares. The required rate of return. Required rate of return is equal to W, the weight of KE, plus the weight of KD. There are no taxes. All right, there are no taxes. So candidate, the required rate of return of an unlevered farm is the same as the the weighted average cost of capital. So the weighted average cost of capital will be equal to the weight, which is 25 over 25. This is the weight. There is no debt. So 25 times 25, the cost of equity is, we read the cost of assuming the farm issues that required rate of 14, this is 16 plus 0. This will be equal to 16%. So the required rate of return of an unlevered farm is equal to the weighted average cost of capital, which is equal to the weight of cost of equity plus the weight of debt. But since the farm is unlevered, there is no debt. That's why I've put here 0, and therefore the weighted average cost of capital of this farm is 16%. Now moving on to part 2 of the question, the market value and required rate of return of this firm's remaining shares after the repurchase transaction according to proposition 2. So the market value, this is Roman 2, the market value, or let me just say the value of the firm will be equal to the value of equity plus the value of debt. Value of equity plus value of debt. The value of equity plus the value of debt. Now, the value of equity is, after repurchase, is 15 million. And the value of debt after repurchase is 10 million, which is equal to 25 million. Because we read that assuming the firm uses 10 million worth of debt with the required with the required rate of return of 14%, and uses the proceeds to repurchase outstanding shares. So the value of the firm is still equal to 25, is the value of the firm. The next part we need to answer is the required rate of return. That is the cost of equity of a levered firm. This firm is levered because there has been introduction of debt in the capital structure of this company. This will be equal to the cost of the unlevered firm plus the cost of the unlevered firm minus the cost of debt times the debt equity ratio. The cost of unlevered firm, we had calculated it here, 16% plus 16% minus cost of debt 14.5% from the question times the debt equity ratio. The debt is 10 million, equity 15 million. This is equal to 16 minus 14.5 times 10 divided by 15 plus 16. So this gives me 17%. So 17% is the cost of the levered firm of this company. Now moving on to part C, I read, summarize 4 disadvantages of using future contracts as financial instruments. Future contracts, part C. Disadvantages of future contracts. Now, what are future contracts? Now, candidates, a future contract is a standardized derivative contract that is created and traded on the futures exchange, in which 2 parties agree that one party, who is the buyer, will purchase an underlying asset from the other party, who is the seller, at a later date and at a price agreed on by the 2 parties when the contract is initiated, in which the exchange, in which there is a daily settling of gains and losses, and there is a credit guarantee by the futures exchange through its clearing house. So it is a contract. in which two parties come together, a buyer and a seller. It is a standardized derivative contract that is created and traded on the futures exchange. And there are two parties who agree that one party will purchase an underlying asset from the other party at a later date. That's why it's referred to as future contract. At a later date. So what are the advantages of future contracts? Do you understand? Now, the first, disadvantage. What is the advantages? The first limitation or the first disadvantage of future contracts is that there is only a limited number of currencies. It allows limited number of currencies. Futures contracts allows a limited number of currencies. Only a limited number of currencies are the subject of futures contracts. Although the number of currencies is growing, especially with the rapid development of economies in Africa, economies in Asia, and so on. So it allows a limited number of currencies to be traded. You may find maybe dollars, euros, and so on. That is futures contract disadvantage number one. Disadvantage number two is that there are what we call hedge, it leads to hedge inefficiencies. Hedge inefficiencies. Hedge inefficiencies. Hedge inefficiencies. These inefficiencies are caused, the hedge inefficiencies are caused by having to deal in a whole number of contracts, and because of what we call the basis risk. And that is the risk that the future contract price may move by a different amount from the price of underlying currency or the underlying commodity. So those who trade in future contracts have to bear with the hedge inefficiencies, which is a limitation of the futures contracts. Number three, unlike options, they do not allow a company to take advantage of favorable currency movements. Do not allow, the futures contracts do not allow a company or a person who engages in it to take advantage. It does not allow the players to take advantage of favorable currency movements. Companies do not allow companies to take advantage of favorable currency movements or changes. Because the price is locked. Okay? The price is set today. So that when there are favorable foreign exchange changes, then the parties cannot take advantage of such movements. So that becomes a disadvantage. Number four, the futures contract cannot be tailored to the user's exact requirements. Cannot be tailored to the user's exact requirements. Futures contract cannot be tailored to the exact user's requirements. That is candidates that the futures contracts cannot be standardized as the requirements of the users, and that becomes a limitation. These are 4 disadvantages of futures contracts. 1, 2, 3, 4. 1, 2, 3, 4. 4 marks. 4 marks. Then part D, the currency market price per ordinary share of Kanga Limited is 58 shillings. A call option exists on the company's shares with an exercise price of 52 shillings and with the 6 months to maturity. The option can only be exercised on maturity, that is, it is a European option. The risk-free rate of return is 6% and the variance of the rate of return on the shares is 15%. Required, using the Black-Scholes option pricing model, estimate the value of the call option 6 marks, and down there the formula for Black-Scholes option pricing is provided. The formula is given for the value of a call, that is D. The value of a call, the formula is given, is equal to the standard deviation N D1 minus strike price E negative RT T and D2. This is D2. That is the value of the formula for value of a call using the Black-Scholes formula. So first of all, we are going to calculate D1, and we know the formula for D1 is equal to the natural log of ST over exercise price plus the risk-free rate plus the variance. This variance, you divide it by 2, then we multiply this by T. Multiply by T, divide by the standard deviation times the square root of time. So, candidates, ST is the underlying asset price, X is the exercise price or the strike price, RF is the risk-free rate, this is a variance, T is the time, this is standard deviation, and that is square root of time. So let's substitute the values. We're going to have the natural log of 58 over 52, the asset price and the exercise price, plus the risk-free rate is from the question, risk-free rate is 6%. Yes, 6%. Converted into decimal, 0.06. Then we add, the variance is 15%, converted into decimal, 0.15. This is the variance. We divide the variance by 2. Divide this variance by 2. This variance we divide by 2. The bracket is here. Then multiply by time. The time here is 6 months. 6 months over 12 is equal to 1.5, which is equal to 0.5. So the time is 0.5. We're going to divide that by the standard deviation. And we know standard deviation is equal to the square root of the variance. Square root of the variance, our variance here is 0.15. Then the square root of time times square root of time, 0.5 times 0.5. So this will be equal to, we go to the calculator. The natural log is in the calculator. So you punch natural log, open a bracket, 58 divided by 52. Close the bracket. This is equal to 0.1092 plus, we remove this bracket, that is 0.15 divided by 2 plus 0.06 times 0.5. This is 0.0675. Divide the square root of 15 times the square root of 0.5, 0.3873 plus square root of 0.5, square root 0.5, 0.7071. This should be equal to, so let's add 0.1092 plus 0.0675 divide, open bracket, 0.3873 times, this should be times, multiplication sign, times 0.7071, getting here 0.65. That is D1. Then D2, the formula for D2 is D1 minus the standard deviation times the square root of time. And we have the D1 there. So D1 0.65 minus the standard deviation, I said, is the square root of the variance, 0.15. The variance 0.15, the variance, times the square root of time, 0.5. So D1 therefore will be equal to 0.65 minus 0.5 minus 0.15 times 0.5. This is equal to 0.38, or let me call it 0.37. This is D2. All right, D2. Let me take it again to be sure here. I have square root of 0.15. This is 0.387 times the square root of 0.5, 0.707. So this subtract from 0.65. .65 minus 0.387 times 0.707 is equal to 0.37. Correct. 0.37. Now we've done D1 and D2. D1 and D2. The next step is to move to the distribution table, the normal distribution table, and put down the values for 0.65, 0.65, 0.65, 0.65, this value here. So we are calculating D1 and D1, normal distribution, and D1 candidates, given that this is a one-tailed standard normal distribution and it is on the right-hand side. The tail is on the right-hand side. Therefore, our figure here will be 0.5 plus this is 0. We are getting 0.D137, 0.37. This is 0. I'm reading from the tables. 0.1443. Then ND2, same thing. 0.5 plus 0.37. This is 0.37, 0.37. 0.37 is 0.1443, and 0.65 should be 0.2422. This should be 2422. D1 2422. D1 2422. D1 is 0. D1 0.65. 0.65. D1 0.65. 2422. Correct. Then D2 0.37. 0.37. 1443. That's correct. So our values will be 0.5 plus 0.2422, 0.722. Then the 2.5 plus 0.1443 is equal to 0.6443. Now these are the values. We're going to substitute the values into the main formula. The main formula, we have the ND1. Our ND1 is 0.7422. So here we substitute the values in the main formula. This is the underlying asset price, we know is 58. Underlying asset price 58. D1, we have it there, times 0.7422 minus the strike price. The strike price is 52 shillings. 52 shillings. We multiply by the D2. Okay, D2 we multiply here 0.6443, right? 443 raised to the risk-free rate 0. And candidates, here you need to be very careful because we have the E, which is a base of the natural log, the base of the natural log E raised to 0.06 times T 0.5. So we've done the substitution. 58 is the underlying asset price. This is the D1. Okay, after reading it and adjusting the normal distribution 0.7422 minus the strike price, also known as the exercise price. We multiply by the D2. This is D2, which we calculated here, D2. Then this is the base of the natural log raised to the, is the base of the natural log raised to negative, this is negative R, the risk-free rate, times time T, 0.5. So we come and insert the answers there. 58 times 0.7422 is 43.05 minus 52. I come here, type 52 times 0.6443. Then I press shift natural log. Then I insert bracket. After this E, make sure you have a bracket. This power, have it in bracket, minus negative. That is minus 0.06 times 0.5 times 0.5, close the bracket. So this gives me 32.5. And therefore, the difference will be the value of this asset, 43.05 minus 32.5. So this, the value here is 10.55. 10.55 shillings That is the value of the call. The question is, using Black-Scholes option pricing model, estimate the value of the call option. So the value of the call option is 10 shillings and 55 cents. So that is how to calculate the value of a call option. The first thing to do is to put down the formula. There are times the examiner will provide the formula, as was the case here. So this is the formula. There are two things, this minus that. Then within this formula, these inputs must be calculated. So we need to have a workings. These are workings. These were my workings. Working 1, working 2, working 3, working 4. These are the variables that are needed in the calculation of the value of call option. How many marks? 6 marks. 1, 2, 3, 4, 5, 6. 6 marks. Then for part 2, these are 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. Then B1, just 2 marks. So 1 mark for value of the firm, 1 mark for the required rate of return, 2 marks. Part A, 4 marks. So we answered question number 3 that was tested in April 2022. The subject is advanced financial management. I want you to go and try out question number 4, but before you move on to question number 4, go to the revision partners. The revision partners, we have done past paper questions still on the same area, all right, the Black-Scholes. Make sure you also revise these areas by answering similar past paper questions. Then you can move on to question number 4 before you come to our next session. Thank you for your patience. I hope to meet you in our next session where we'll have a look at question number 4. Thank you. God bless you. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017. And we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5% 4%, 3.5 and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas, and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here. Because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS. And that's exactly what we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there. And like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation amortization. In real life, trying to model depreciation amortization will prove to be a bit of a challenge. Determining will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here, the interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard-coded values. We just drag them. That. Remember that this value here is bound to change, as well as this value is bound to change, because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, is a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable. Yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply it by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365. By 365. Over here, 365. That. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we are saying we get the accounts receivable times 365 over revenue. Just rearranging this formula. And that's exactly what we're going to do over here. We get the days. The days are here. See where they are. Just a second. Accounts receivable days. There. And then we multiply that with the revenue. Then we divide over 365. And we have that value given to us there. So shift Control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365. That. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out, because this is a formula. So shift Control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. The same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days. Accounts payable days, you can see the accounts payable days are here, 37, and then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that, because this is a formula here, it's just the total. So this one I'll put it in a different color, so that for consistency's sake, to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here, and we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right, and this one remains like so. So shift Control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance, because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us to fill and ensure that this one balances off, the balance sheet balances off based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement, and we will be able to also do a check for the cash flow statement and write down over here to determine if we are actually cooking figures or not. We jump on to the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable, you remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here, and you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that, and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net, the net working capital component. So just put it like that, and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that, then now I can drag it moving down like that, Shift Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is there picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section, this one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up over here. So debt and issuance repayment right now here, you link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, to R. And in a good account or analyst format, we just make sure that this part is the same color, because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So we're saying it's going to be from the supporting schedules down. So we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So we pick the closing balance there, and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules right here. Change in net working capital, and we are saying we are going to pick that value. So because this is black and it's a formula, you can just drag it like so. Now we're almost there. but we're not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex. Capex, you can see the capex is here. Link it with that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt, here. And remember, they are following each other with equity. So, like that. And this can be dragged like so, because it's a formula, and we can complete this by doing that, by dragging the formulas moving to the right. The net increase or decrease in cash is a formula, because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing, because that's money going out, and then we add cash from financing, so that we can be able to get the decrease in or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now, to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise, because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you.
Hi students, welcome to another session of Manifested online classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us to look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us to go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of two brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following trial balance was extracted from the books of the society as at 31st of December 2021. We have a trial balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued rents, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number 1, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for $175,000 US and $115,300 US respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you are told market Safi and Mzuri brands on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those two coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we are given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1 US. And then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, we have said when translating the sales for the two coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account. That is on 15th of January 2022. 2022. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura Cooperative Society for the year which ended 31st of December 2021. Number 1, Safi Brad marketing account showing the profit and loss. Number 2, Mzuri Brad marketing account showing the profit or loss. And part C, statement of profit or loss for the year which ended 31st of December 2021. And finally, statement of financial position. So as far as the first two accounts are required, part A and part B, whereby you're required to prepare the marketing account of the 2 coffee brands, we're required to prepare those 2 accounts basically to show the profit or the loss which was realized from selling these 2 coffee brands. And what we are going to do, we are going to take now the sales, the sales of the 2 coffee brand, which is given in the additional information number 1, and then there is some information which are given in paragraph 1 that this cooperative society is required to retain 20% of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1, and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%. Then we are going to less now the expenses, specifically relating to those 2 coffee brands. So we start with part A. Part A of that particular question. We are required to prepare a Safi brand marketing account, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales. The sales from this coffee brand, and we are given that information in additional information number 1. We are told the sales from this coffee brand, that is a Safi, it was $175,000 US dollars. 175,000 US dollars, because these sales are in US dollars. So what we need to do, we need to translate these into Kenyan shillings. I've said we're going to use now the exchange rate when the money was remitted now to the bank account of the cooperative society. The money was remitted on 15th of January 2022, in which case now the exchange rate was 100 shillings, which was equivalent to $1 US. So we multiply that with what? With 100, so that we get the final figure here. So let's get the final figure. So this is 175,000. 175,000 then times 100. So that will give us 17.5 million. Take into account our figures are in thousands of shillings. So that will be recorded there 17,500. Then what you are told is that out of these particular sales from these 2 coffee brands, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members, or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we less now the expenses. So first of all, we have now to deduct amount due to members. Amount due to members, and basically in this case we have said the amount due to members is 80%. amount due to members. That amount due to members, in our case, we have said is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. 20%. So what is 80% of 80% of this? 80% of 17 500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, this amount should be equal to 20% of this. Maybe you can just confirm 20% of 17 500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and list now the expenses. We list the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand. And those particular expenses are given in the trial balance. I think the first item is the trial balance. We have the expenses associated with marketing and selling a Safi. So we have marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860. And then we have processing wages, which is an amount of 900. Yes, an amount of 900. So wherever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee brand. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings, and we're following the same format. We start with the sales of this particular coffee brand, and that is given in the additional information number 1, which was 115,300. But this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society, and this will give us 11,530,000. So just like what we have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, we have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 23.06. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. So we have marketing expenses. Marketing expenses, an amount of 150. And then we have processing materials. Processing materials, an amount of 320. And then we have processing wages. Processing wages, which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee brand. So what do we have here? We have an amount of 2306 minus 150 minus 320 minus 30. That gives us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. And these are some of the items which were marked as far as that part is concerned. And by doing that, you get now your three marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency, which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, this one will be recorded there as a liability, because this what the cooperative society was supposed to pay to the members, it had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. In part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the for the entire cooperative society. Remember what you have prepared in part A. Part B is prepared to determine the profit from marketing and selling the 2 coffee brand. So part C, we are required to prepare a statement of profit or loss, statement of profit or loss, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have 2 columns. And we prepare these by comparing the incomes of a cooperative society with the expenses. With the expenses, automatically we start with the incomes and then we less the expenses. So which are some of the incomes of this particular cooperative society? So even before you go back to the trial balance, because we know our cooperative society is responsible for marketing 2 coffee brands on behalf of the members, we know that from marketing of the 2 coffee brands, there was a profit of 1,100 from marketing and selling of Safi, and 1806 from marketing and selling of what? Muzuri. So that is the first source of income to this cooperative society, and that is what we bring here. So profit from the 2 coffee brand Safi, which is a figure of what? Of 1,100, and then we also have the profit from the other coffee brand, which is Mzuri, a figure of 1806. Then what we need to do, we go back to the trial balance, we take the other incomes of this cooperative society. It's important for you to remember all incomes have a credit balance. So when checking for incomes from the trial balance, you check the items on the credit side of the trial balance. So the items on the credit side, I think the first item, we have dividends from investment, dividends from investment. Dividends from investment is a figure of 470. Below that, we have accrued rent. Accrued rent, these are liability. Sundry creditors is a liability. Appropriation account, these are like the retained profit at the start of the year, which is not an income. Revaluation reserve is a component of equity. Statutory reserve fund is a component of equity. And then below that, we have entrance fees. This is still an income to a cooperative society, and these entrance fees is a figure of what? Is a figure of 300. Below that, we have share capital, members deposit. None of those is an income. Sundry creditors, bank overdraft, all those are items of liabilities. And I think finally we have interest on members' loans. Interest on members' loans, members, or interest on loans to members. Remember what you have said is that once a cooperative society give loans to the members, a cooperative society definitely will have to charge some interest. That interest charged by the cooperative society is basically what? Is an income. Yes. So I think those are the only incomes which we have. So then what we need to do is to get the total incomes. So let's add all those figures so that we get the total incomes. We have 1,100 plus 1806 plus 470 plus 300 plus 35 890 890. Okay. Yes, that will give us the total incomes of 39,566. Yes, after getting the total incomes, what do we do next? We proceed and we less now the expenditures. The expenditures of these cooperative societies, expenditures of the cooperative society. So here we have a number of expenses, and before taking the expenses in the addition in the trial balance, it is always advisable first of all deal with the expenses affected by the additional information. Let's go to the additional information. In the additional information, number one, I think we had information about sales of the 2 coffee brands. That has nothing to do with the expenses. Number two, the exchange rate that do not affect expenses. And then number three, we are told audit fees to be provided for. Audit fee to be provided for, that is an expense. But equally, because we are told this audit fee was provided for, it means that when the year was coming to an end, this audit fee had not been paid. Meaning that in our statement of financial position, there is a liability. So we have audit fee of 6 million, but remember all our figures are in thousands of shillings. And then number four, we are told staff salaries and wages amounting to 3.2 million had not been paid. So we have staff salaries and wages. So what we do, we take the amount which was not yet paid at the end of the year, which is 32, and then we add to this, we add the amount which had already been paid, and this is the amount appearing in the trial balance. So the amount appearing in the trial balance as the staff salaries and wages is a figure of what? Yes, is a figure of 2290. 2290. So we add the two figures, so that now we get the total staff salaries and wages for that year. So we have a figure of 3200 plus 2290. So the total staff wages and salaries for that year is a 5490. So let's go to note number 5. Interest on members' deposit is to be provided for. Remember, in this case, you have said that interest paid to members based on their deposit, this is an expense. This is an expense. And equally, it is also important to note that this amount are not being paid. It's just provided for. So therefore, still in preparing our statement of financial position, this will be a liability. So I think we are done with that point. And then number 5 is all about the amount to be transferred to the statutory reserve fund. That is not an expense. So what that means is that we go back to the trial balance which you are given, and we pick now all the other expenses. It's also important to note that all expenses in the trial balance, they have a debit balance. So we check the items on the debit balance, on the debit column of the trial balance, that is. And I think we can start from where we have traveling expenses. That, I think, where we have the first expense. It is important for you to note that we have some expenses which relate to these 2 coffee brand, Safi and Mzuri, and because we captured those particular expenses here in preparing this particular account, we don't take into account those particular expenses. Those expenses specifically relate to Safi and Mzuri. What we are recording here are the general expenses relating to the cooperative society. So we have traveling expenses for staff and committee members, a figure of 80 and 100. And then we have bank charges. Bank charges, an amount of how much? An amount of 200. We have bank interest. Bank interest, which is a figure of 890. Then below that we have salaries and wages. We have already dealt with that here. And then we have committee education. That is the other expenditure. Committee education, which is an amount of 1,000. Below that we have committee seating allowances. This is committee allowance. We have committee okay, this is a committee's education. Committee's education, which is 1,000. Then we have committee seating allowances, which is a figure of 1110. And then we have printing and stationery. Printing and stationery. So printing and stationery, we have a figure of 2050. And then we have general meeting expenses. General meeting expenses, an amount of 500. Below that, we have members education. Members education. Members education is a figure of 1,500. And then below that, we have entertainment. Entertainment. Entertainment is a figure of 50. And then next and finally, we have the legal fees. The legal fees, which is a figure of what? Of 400. So those are, I think, the various expenses which relate to this cooperative society. I hope we have not skipped any. Yes. So what then we need to do, we need to add all those particular expenses of this particular cooperative society so that we can be able to determine the profit or what? The loss for the year. So let's add all these particular expenses, starting from where we have audit fee, 6,000 plus 5490 plus 6086 plus 80 plus 100 plus 200 plus 810 plus 1,000 plus 1110 plus 2050 plus 500 plus 15 plus 50 plus 400. Yes, so that is giving us a total of 376. So what we need to do, we need to less that now from the total incomes which we have here. We deduct that from 39,566. So that will give us the profit for the year. The profit for the year of 14,190. 14,190. So basically that is it, that what is required as far as that part was concerned. Preparation of the statement of profit or loss, and in that case now the examiner had given how many marks? The marks were allocated to that were 6. So by recording those particular items of incomes and expenses, you had to get now 6 marks. So finally, let's prepare now the statement of financial position as required in part D of that particular question there. So you prepare statement of financial position. Statement of financial position. That is part D. You can just refer to it as abbreviated as SOFP, as at 31st of December 2021. 31st of December 2021. So remember, you say that it is a statement of assets, liabilities, and equity. So we just need to have a single column here. And we start by recording assets. And remember what we said in our first session, as far as this is concerned, we don't need to classify the asset into non-current and current. We just record asset starting from the most liquid to the long term. And I think we are given the asset starting from where we had our last expense, the legal fee. Below that, we have cash in hand. Cash in hand. The cash in hand is a figure of 540. Then below that, we have Wakulima Bank. Wakulima Bank Limited savings, which is an amount of 6780. And then we have still investment in Wakulima Bank Limited. Wakulima Bank Limited, which is a figure of 6550. Then below that, we have receivables. We have receivables from members, which is a figure of 2960. We also have receivables from non-members, a figure of 22,500. And then we also have office equipment. Office equipment is a figure of what? Is a figure of 900. Yes, so I think those are some of the items which we have in the trial balance. But I think also below the various expenses relating to Safi and also Mzuri, we have now the loans to the members. Remember, we have said that once a cooperative society has given loans to the members, advanced loans to the members, these particular loans to the members to a SACCO or even to a cooperative society is an asset. The cooperative society expects now the members to repay back that amount of money. So basically that is an asset. Then what else do we have maybe from the additional information? From the additional information, number one, we have now the amount which this cooperative society was yet to receive from the marketing agency, which is Bora Limited. So we can just refer to that as the amount due. This is the amount which was not yet remitted to the bank account of the cooperative society by the marketing agency, which is known as what? Bora Limited. And this amount, because it is given in terms of US dollars, we have now to convert that now to Kenyan shillings. So we take the sales from Safi, 175,000 US dollars. We can just take it as 175. And then from the other coffee brand, 115.3. And then we get the total. We translate that now to the Kenyan shillings by multiplying that with the exchange rate on the date the money was remitted. So we have 175 plus 115.3 times what? Times 100. So this is the amount of money which now Bora Limited was yet to remit to the bank account of the cooperative society. So therefore, to the cooperative society, this is basically an asset. So that's what we have in note number 1. Additional information, note 1. Note 2 has nothing to do with the sales. Note 3 is that is a liability. Note 4, that is still a liability. And then number 5 is still a liability. And then number 6, this one will affect now the appropriation account. I'll be able to show you now the necessary what? Adjustment we are going to make as far as that is concerned. Yes, so what we need to do here is to get now the total assets. So let's add all these assets starting from where we have 540 plus 6780 plus 26 550 plus 2690 plus 22,500 plus 900 plus 972 340 plus 29,030 Yes, that will give us a total figure here of 1,061,330. So those are the total assets. Next, we record now equity. Equity, this one comprises of a share capital, members deposit, plus the various items of what? Of reserves, of which all these items, they have a credit balance. So let's start by recording the share capital of this cooperative society that is given in the trial balance. Share capital is given as a figure of 900. So then below that we have members deposit, which is a figure of 64,650. Yes, and then from there we have various items of reserves, starting with just above the share capital entrance fee, we have statutory reserve fund. This one will need to be adjusted because whatever you given there as a statutory reserve fund, this is a statutory reserve fund at the start of the year, and then what you're told as per note number 6 is that 20% will 20% of the net earnings is the same with the profit for the year, will be transferred to statutory reserve fund. So this should be 20% of what? 20% of this profit for the year. 20% of that what? Profit for the year. So it should be 20% of 14,190. So that we get the statutory reserve fund at the end of what? Of the year. So then below that, or basically above that, we have revaluation reserve. Revaluation reserve that remain the same, which is a figure of 750. We are going to compute that figure. And still we have appropriation account. Appropriation account, this account still, or this figure still need to be adjusted because what you're given there is the appropriation account at the start, which is what? Which is 6050. To this, we should add the profit for the year. The profit for the year, remember, is 14,190, but equally we are going to less the amount which was transferred to the statutory reserve fund, which is 20% of 14,190. 14,190, and we get now the appropriation account balance at the end of the year. So I think we have picked all the items of equity. We have picked all items of what? Of equity. So I think what we just need to do here is to get now these final figures, starting with the statutory reserve fund. So let's first of all get 20% of this, 20% of 14,190 plus 13,740. That will give us 16,578. What about the appropriation account balance? So we have we have what? We have 6050 plus 14,190, and then to that we less what? We less 20% of 14,190, and that will give us 17,402. Yes. So those are the items of equity. So what we then need to do is now to get the total equity. Let's get the total equity by adding all these items, actually starting from there. We have 17,402 plus 750 plus 16,402 578 plus 64 650 plus 900,000 which will give us 999,380. So that is the total equity. So what we need to do next, or actually finally, we need to record now the liabilities. We need to record now the liabilities. We need to record the liabilities. The liabilities. So we have various items of liabilities. Let's start with what we have in the additional information. In the additional information, number one, there is something, first of all, you need to remember that there was amount due to members. There was some amount which was this cooperative society was supposed to pay to the members, which was 80% of this amount, which was from the sales of the 2 coffee bread. So we can just compute that as 80% of this, 80% of 29,030. Although if you go back to what we prepared in Roman 1 and also all part A and part B, you can be able to see the amount due to the members as far as the sales of the 2 coffee bread is concerned. If you add those, the amount from Safi brand marketing account, Mzuri brand marketing account, should be able to get the same figure here as 80% of the total sales of the 2 coffee bread. So we have 80% of 29,030. That will give us 23,224. This amount which this cooperative society was yet to pay to the members. So that's what we have in note 1. Number 2 is about exchange rate. Number 3, we have provision for audit fee. For audit fees, this amount was not yet paid. It was just provided for. So therefore, it is a liability, 6,000. And then number 4, we have accrued salaries and wages. Accrued salaries and wages is 3.2. And then below that, number 5, we have provision for interest on members' deposit. Members' deposit. Still, this amount are not being paid. It was purely provided for. That's why we are accounting for it as a liability there. I think with that, what we have. Yes. So let's then go back to the trial balance and we pick now the other items of liabilities. Remember, all our liabilities, they have a credit balance. So starting from where we have dividends from members, below that we have accrued rent. Accrued rent, which is 470. Below that we have salary provision. Salary provision 4950. 4950. And then down there we have salary creditors. Salary creditors, which is a figure of 3410. And then we also have a bank OD, bank overdraft of 6150. Yes, so I think we have recorded all items of liabilities. None of the item which you have not recorded. None of the item which you have not recorded. Yes, so what we just need to do here is now we get the total. We get the total equity and liabilities. So for the total equity and liabilities, we take the total equity there and then we add all these items of liabilities. But let first of all we add these items of liabilities. We have 23,224 plus 6,000 plus 3,200 plus 60,86 plus 470 plus 4,950 plus 3,410 plus 6150. Yes, plus what we have there is 999 380. Okay, let me take that again. Okay, so we have what? We have 999 380, and then we have 23,224 plus 6,000 plus 32 plus 6086 plus 470 plus 4950 plus 3410 plus 6150. Yes, so that is giving us the same figure there as 61 330. 61 330. So basically that is what was required in that part D of that question. These are the items now which were to be marked. The items to be marked, but definitely that particular statement of financial position, as you can see, there are so many entries, so many what entries, and basically by doing that, you are allocated 8 marks as far as that question is concerned. So that brings us now to the end of that particular illustration as far as the preparation of financial statements by cooperative societies are concerned. And I think that is the most recent question on cooperative societies. There is another question which was tested back in the year 2010. So if you can be able to access the past papers for 2010, you can be able to check a question which was tested. So I think was question number 4 from that particular sitting. So therefore, we stop at that particular point. See you in the next session as we move to a different topic.
How are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where if I can give you a little of recap of what we did, is that we said that there are 3 businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have 2 or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you're taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see how do we normally tax the partnership business. First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by by 2 or more people which is not registered as a company, and so does not have a separate legal entity. that is the definition of the partnership. But our objective or goal is to know how we usually tax the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider. While taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or A, gross profit method, or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you're determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses. Are not allowable in partnership. I.e., salary to the partner, to partners, interest on capital, interests on capital from partners to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salary to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes. Are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income. Any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you'll hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they are charged interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. After the distribution. The gross tax once determined, then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income, tax individually at graduated scales. Partner B, how much is the taxable income, tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution, stock allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals: shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. Interest on drawings. So interest on drawings here, you less if anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share. Shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on doings, profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment there. And now, if you're asked about now taxing, getting the tax payable by partners, you will tax this one A individually on this using the graduated skills, the way we tax them sole proprietors income. The same case, this one, B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says.
Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. Today we're going to study the legal audit as a subtopic under the chapter on Introduction to Corporate Governance. In our last session we discussed the compliance obligations. Today we're moving on to legal audit. By the end of this lesson, you should be able to define legal audit, should also be able to explain the importance of or the objectives of legal audit. Legal audit. Remember in our last session we said that compliance is the process of adhering to rules, regulations and laws. We also mentioned that a company should put in place a system to monitor and check if the company is adhering to rules, regulations, and laws. And legal audit then is defined as the inspecting or the inspection of the company's activities, transactions, and practices to establish their compliance to its constitution and with the applicable authorities. Legal audit is the process of inspecting the company's activities, transactions, and practices to establish if the company is adhering to laws, regulations, and rules that are applicable to the company. It can also be defined as the systematic review of the company's transactions, contracts, and practices to establish its legal status and identify the potential legal problems. It may also help minimize its legal liability. So the main purpose of legal audit is to help the company minimize risks and potential legal liabilities. It focuses on subjects like the form of business organization, the review of taxation law compliance, a review of intellectual property issues, use of internet, the human resources, among other areas. Though legal audit covers such areas. So I've defined legal audit candidates as the inspection of the company's activities, the company's practices to establish their compliance to laws, regulations, and rules. It is the inspection of the company's activities, the company's transactions to establish compliance with laws, to establish compliance with laws. It is the inspection of the company's transaction to establish compliance. All right? It is the systematic review of the company's transactions. It is the systematic review of the company's transactions, the company's contracts and practices to establish its legal status and identify potential legal problems and help minimize its legal liability. So let's now study the objectives. What are the objectives of legal audit? objectives of legal audit. Objectives of legal audit. Now, objective number one, candidates, is that legal audit promotes accountability. Promotes accountability. Legal audit does what? Promotes accountability. By doing what? By reporting deviations from violations of authorities so that corrective action may be taken by the company. Because when you are carrying out a legal audit, you on one hand have a list of the requirements, the legal requirements. Then you check if the company has complied, you tick, all right, with this one, complied. Number two, complied. Number three, not complied. So it's a systematic review of the transactions of the company. It does what? Promotes accountability. When review is carried out, when the activities are compared vis-a-vis the requirements, then it's possible to identify areas that have not been complied with. So the legal audit will identify deviations, and that promotes accountability. Two, identifies the company's legal liabilities. A legal audit can help identify a company's legal liabilities and risks beforehand. And risks beforehand. It helps, in other words, identify the potential liabilities and risks before they come up, all right? And if it's possible to identify legal liabilities and risks beforehand, then the company can come up with a way of averting potential lawsuits and penalties. And that is a sure way of saving the company's money in litigation costs and other unnecessary expenses. The third objective of a legal audit is that legal audit helps the company become or remain compliant. Helps the company remain compliant. It helps the company to remain compliant with the laws and policies that are put in place as it exposes the laws that have not been complied with. And that provides a way of complying with the laws that have not been complied with. Because when you carry out a legal audit, it's possible to identify the laws that have been complied with and the laws that have not been complied with. So the laws that have not been complied with, they can now be complied with as a result of carrying out a legal audit. 4, promotes good corporate governance. A legal audit promotes good corporate governance, both by identifying the weaknesses and deviations from the law and regulations, and by assessing propriety. All right? It promotes good corporate governance by, 1, identifying weaknesses and deviations from laws and regulations, and by assessing propriety where there are insufficient or inadequate laws and regulations. And when that happens, then fraud and corruption are by their very nature elements which counteract transparency, accountability, they counteract good stewardship and so on. So Good legal audit promotes good corporate governance. Then number 5, a legal audit also demonstrates that the company's directors and managers have carried out due diligence. Due diligence. By carrying out a legal audit, that demonstrates that the management has done what? Has carried out what we call due diligence with regard to the activities undertaken, thereby minimizing their exposure to personal liability. When the directors conduct a legal audit, that legal audit helps the company to carry out due diligence. That demonstrates that the directors have done what? Have carried out due diligence with regard to the activities undertaken by the company, and that minimizes the exposure to liability, minimizes exposure to directors' personal liability. When directors carry out a legal audit, then they are reducing the possibility of personal legal audit, because they would have conducted their work as required by laws, as required by regulations, rules, policies, and so on. So these are 5 objectives of a legal audit, and that will mark the end of the lesson. Remember, the objective of this lesson was that by the end of the lesson, you should be able to define legal audit and explain the objectives of a legal audit. And that will form the basis of your today's assignment. Define a legal audit. 2, highlight 5 objectives of a legal audit. That is your assignment. When answering the question, ensure that you do not directly refer to the notes. See if you can recall what you have learned in our today's lesson from your memory. Thank you. God bless you. Bye-bye.
And from there now, I would want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Kamara, Susan, and Kubasu are a partnership, trading as Kasuku traders, sharing profits or losses equally. They have provided the following statement of profit or loss for the year ending 31st December 2021. We have the gross profit, VAT refund, foreign exchange gain, dividend income net, a profit or disposal of furniture, rent income, then total income, then less expenses, insurance premiums, legal fee, depreciation, repair and maintenance, VAT paid, sundry expenses, interest on capital for Kamara, Susan, and Kubasu, motor vehicle expenses, custom duty, accountancy fee, bad and doubtful debts, rates and rent, salaries and wages, net loss. Additional information. Number 1. Insurance premiums include 282,500 paid to insure Susan's private car. Legal fee include parking fine, settling a dispute with a customer, appeal against tax assessment, court expense for breach of contract, preparation of tender documents. Number 3. Sundry expenses include interest charged on hire purchase, cash embezzled by cashier, registration of trademark. Number 4. Repair and maintenance comprised of the following: repair of furniture, installation of surveillance camera, cost of office furniture. Number 5. The partners took goods for personal use which had cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. The investment allowance were agreed with the Revenue Authority at 1475,000 during the year ending 1st December 2021. Salaries and wages included salaries to the partners as follows: Kamara, Susan, Kubasu. So we are required to have the adjusted partnership profit or loss for that year and distribution schedule of the profit or loss computed in C1 above. So we prepare the income distribution schedule after getting the taxable income. So the first question is to get the taxable income of the partnership. Question is, which method are we supposed to use? Here we said if you are given net accounting profit, then you use the net profit method. Here we are given the net loss, which is a negative profit, that automatically means that you're supposed to use the net profit method. So we solve the question. We start with the name of the business, Kasuku Traders. Which is a partnership. We get the taxable income for the year ended that 1st December 2021. As we had said, when you are given the net accounting profit or loss or income, we start with it and then we adjust it. So we'll start with net loss provided, which we are given in shillings, and we have 2956. 2956,000 negative or a loss. Then we add, we had said when you're using the net profit method, you add non-allowable expenses in P&L and taxable operating income not in P&L. Non-allowable expenses in P&L and taxable operating income not in P&L. What does that mean? We usually start with the first item, non-allowable expense in P&L, meaning in this P&L is the profit and loss account, which is the income statement. That in this income statement, as you can see, incomes were added and expenses deducted to get the net profit, which is a negative profit anyway. So we are saying, of those expenses that were deducted, is there an expense that is not allowable? So that now it had been deducted to get the net profit. It's not allowable. It's not supposed to be deducted. We add it back. Before we go to the last one, I'll show you where we find it, because that one, as you can see, not in P&L. So we finish with this first one, as we had illustrated earlier on. Let us start with the expenses. We just follow the ones that are in the P&L. Insurance premium. Insurance is for the business, and it is usually allowable expenses. The other one is legal fee. Legal fee is also allowable, as long as they have not extended to what they entail. Depreciation, no. Depreciation is not allowable, as we have been saying, so we add it. It had been deducted, remember, and it is not allowable. 575,000. The other one is repair and maintenance. Repair and maintenance, that is allowable. It's for the business and it's allowable. VAT paid. We said any form of tax we don't allow. Any form of tax. VAT is a tax. Value added tax is not allowable. Had been deducted to get the net profit, and it's not supposed to be deducted. It's not allowable. We add it back. Next, sundry expenses. That those sundry expenses are small expenses put together for the business, and they are allowable. Interest on capital. We had even said it here that anything paid to the partners is not allowable. Partner salary, commission, interest, drawings, and private expense we don't allow. So that one had been deducted and it's not allowable. So interests on capital, which we have Kamara, we have Susan, Kubasu. So Kamara for 7,500. The other one is 185,000. The other one is 146,000. Then we continue motor vehicle expenses. Motor vehicle expense, those are expenses to run the motor vehicle. Don't say it's the cost of motor vehicle. When you hear motor vehicle, they are the expense to run motor vehicle, like fuel, repair. Those are allowable. But if they say the motor vehicle cost, that's now the cost of a motor vehicle. Fixed asset we don't allow. So this is allowable. Next is custom duty. Custom duty is a form of tax. We don't allow taxes. So we'll add it. Which we have 227,500. Next one is accountancy fee. Those are professional fee you pay. They are allowable because they are for the business. Bad and doubtful debt. Now when you hear doubtful debt, is a provision, a general provision, because you are doubting that they might not pay, they might pay. So it's just a provision. We don't allow provision unless it's specific provision for bad debt. The next one is rates and rent. Rates and rent, those are allowable expense because they are for the business. Salaries and wages, we also said those are allowable. They are for the business. They are revenue and commercial expenses. Now look, we are done with non-allowable expenses in P&L. Now we can look for taxable operating income, not in P&L. What does that mean? It means that an income that is taxable, but it has not been included in the P&L, in the income statement up here. So meaning it didn't increase the net profit that we have down there, although it's a loss, it's a negative profit. It didn't. So if it is not in the P&L, it didn't increase this net profit. Where do we find it? We can only find it in the additional information. So we go to the additional information to check for an income not in P&L. If they happen to be taxable operating, then we are going to add. However, when we go to the additional information, there's something else we normally check. You see, we say we are done with the expenses in the P&L, but you may go to the additional information and you are given analysis of those expenses that are in the P&L. Like the last expense we had salaries and wages in the P&L. You may go in the additional information and you're told that was to the partner. Remember, salary to the partner we don't allow. So we still come back and disallow it. So in the additional information, we not only look for